Good afternoon, members. On behalf of Western India Regional Council, I welcome all of you to this signature event of Western India Regional Council DTRC. I request WIRC Secretary CA Saurabh Ajmera to escort the dignitaries to the stage. Bhaskaran sir, Nihar Jambusaria sir, Piyush Chhajad sir. I request all of you to please occupy. I'll request all the members to rise for ICAI motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Thank you. By and large, we all chartered accountants are predominantly have been doing audit and tax work. Tax being, most important work. DTRC, the Direct Tax Refresher Course, has been a signature event of ICAI. We all practicing CA are heading towards completing the work of filing the returns of assessment year 2023-24. There have been a lot of amendments, a lot of updates which needs to be understood with the endeavor to have the expert on each subject. This 4 Friday, Saturday program have been organized as usual. And very happy to see all of you in large number. Once again, on behalf of Western India Regional Council, let me welcome all of you. Welcome all the dignitaries on the dais. With this, I request Central Council member CA Piyush Chhajad to give his opening remarks.
Thank you very much, Ketan bhai. Honorable Chief Guest, ITAT member, Bhaskaran sir. Honorable past President of our Institute of Chartered Accountants, Nihar bhai, Nihar Jambusaria ji. On the dais, Saurabh Ajmera, Secretary, Treasurer, Ketan Sayya. Central Council member in the front row, Preeti Savla ji. Other regional council members, past regional council members, past chairmen, seniors in the professions, and the esteemed members of our fraternity Institute of Chartered Accountants of India. Very good afternoon to you. As a Vice Chairman of Direct Tax Committee of ICAI, it's my immense pleasure to be amongst you and to address this flagship event of WIRC, that is Direct Tax Refresher Course, which I believe the members generally look forward to every year. And whenever this program is announced, there is never a rush for a registration happening. Otherwise, generally, WIRC always keeps on chasing where the members for the registration. But this is the event wherein generally WIRC members do not have to chase the members for getting their registration done. It gets automatically done. That's what this flagship program speaks about it. Coming to the activity of the Direct Tax Committee as a part of the Central Council member, the 4 or 5 very important activities which I would like to throw upon light, I thought it would be appropriate at this stage to appraise the members in the next 2 or 3 months which DTC is proposing. One is the most important is the revision of the tax audit guidance note. The revision of tax audit guidance, so this would be done again. It was done last year after a gap of 6 to 7 years. So again, it would be revised tax audit guidance note, and the groups have been formed. Revisions are already under the process, and I believe by the mid of July, we will be able to come with the revised guidance note. If we are able to complete by 15 June, and then it will come in the public for the general public exposure draft will come for the comments to get comments from the public, and that will be coming in. The most important thing, as you are aware, there is the most maximum amendment which is taking place when it comes to direct taxes in regard to charitable institutions. A lot of changes have come. New audit report forms have come, 10B, 10BB. If you actually look into 10B or 10BB, now the scope has increased, which is much wider than the Form 3CD also. And that is the most challenging. And for the professional members, the audit of charitable institution has never been remunerative also. Majority of them is doing it without any particular fees. At the institute level, we thought it is very appropriate at this stage to come with an implementation guide. Obviously, we would have come with a guidance note, but generally guidance note takes time because it has to, as I mentioned, the exposure draft has to come. We have to wait for the public comments. So initially, we are planning to come with an implementation guide. Again, the groups have been formed. It's already at the advanced stage. The first cut has already come. A lot of discussion has been happening with the experts in the charitable institutions. I can see Shardul Shah, who is also contributing to that. So we believe that by, again, the mid of July, we are able to come with the implementation guide. And our endeavor would be, once the implementation guide has come, we'll also try to convert that implementation guide into a guidance note, which has a much bigger authority when it comes to the authority to the pronouncement made by the institute. As you may be aware, the guidance note are, though may not be a mandatory, but they are mandatory in the sense that if you are not following the guidance note, you have to have a justified reason for not following it in compared to the implementation guide, which is recommendatory in nature. So that is the two areas, very important area, which I think so will see the light of day within next 1.5 or 2 months. We are planning to release it by end of the July, so you get a sufficient time before closing the audit in August and September. Coming to the other aspects is we had a meeting with CBDT chairman, and as a part of our continuous engagement with the CBDT and the government at the institute level, we have proposed them that we should have a clinics, tax awareness clinics for the general public at large to increase the tax widening base. It may be like chartered accountants, we have a 164 branches, so we have offered that and they have accepted. There has also been a meeting with the public relation team of the CBDT, and they have accepted most probably on 13th and 14th July. And that would be also part of celebration of 75th year of the institute, wherein we will have a tax awareness clinic across the board, wherein the members of our institute, 2 or 3 members, and the 2 or 3 members from the income tax department will have will sit a particular place and guide the general public as to importance of why they should have a PAN. Why should they file return? How does it helps in the nation building? And the most important objective being to create awareness about the public, and from the CBDT side, it is also for increasing widening the tax base. So this is the third area which we are working upon, and I'm sure we'll be able to do that. Fourth, and most importantly, other than this, we have also proposed to have a grievance cell. There is a lot of queries keeps on coming from the members that whenever the grievances are raised in regard to 143(1) CPC adjustments are happening, and a lot of appeals are also now coming against the order passed under 143(1). Even the honorable member would be aware, a lot of appeals are coming because those grievances are not been addressed by the CPC. So we have proposed that again a representation from the income tax department and from our members who can consolidate such grievances and actually try to deal with it, take it forward to the CPC and try to resolve that. That would be an important area. Again, which CBDT has agreed to it and probably will be coming out with a modus operandi for the same. And I think so that should also come in a certain period of time. So with this, I thought it would be appropriate at this particular stage that to brief the activities as far as direct tax committee is concerned. This has been a direct tax program. I've been the vice chair of the direct tax. And if anybody has any of the suggestions on this direct tax, please do write to us. It would be our endeavor to take it forward, whether at the government level or any particular body. With this, I welcome you all on behalf of Institute of Chartered Accountants of India. Chairman Arpit Kabra has already joined. Please do come in, Chairman. And obviously, the welcome remarks has to be given by him, but I have taken his place in between in his absence here. So I welcome you once again and have a happy learning. As said by Ketan, yes, predominantly direct tax is still today one of the major source of revenue for the practicing chartered accountants. And that shows the importance of such seminars, such programs. I welcome you very much. Thank you very much.
Thank you, Piyush Bhai. I think it's wonderful to listen from our leaders at Central Council. Piyush Bhai, being first time in Central Council, has been taking a lot of initiative, a lot of new initiative. Let me also recognize presence of Central Council member Preeti Savla Madam. Again, a lot of new initiative taken by her in terms of sustainability, social stock exchange and exams which are being implemented by ICAI. Also call Sahayata number 9975 9975. Lot of efforts being put in by her. Thank you, madam, for your all the valuable support. We are also having past president Nihar Bhai, Nihar Jambusaria. Nihar sir, again we have been seeing the way Nihar Bhai has worked during his tenure as a president. So we are very happy to have you here as a first speaker of this wonderful program. Moving forward, may I request our regional council member Rudesh Pankhania to formally introduce our honorable ITAT member B.R. Bhaskaran sir.
Good afternoon, everyone. It's my sheer pleasure to introduce Mr. B.R. Bhaskaran, the ITAT accountant member. He's born in Madurai. His educational qualifications, along with BCom and Chartered Accountant, he's also done his DISA and ICWA and ACS Inter. He joined government service on 12th November 2007 and presently posted at Mumbai. He's due to retire in April 2025 and has been a practicing chartered accountant earlier since 1986. With a huge round of applause, let's welcome Mr. B.R. Bhaskaran, sir. Thank you so much.
Thank you, Rudesh. Before we move on and request sir to address, let me invite all the dignitaries and regional council members, central council member, even Shardul Bhai, who has been supporting a lot to us in various activities for the lighting of lamp. every year, Western India Regional Council also publishes a reference manual. The reference manual is a great research work. Almost there are 200 chartered accountants supporting this activity. And within a span of less than a month, we create update and short notes on almost 10 topics, 10 areas of practice, which includes income tax, GST, RERA, FEMA, various. Today is the occasion to release this publication for the year 2023-24 in the August hand of B.R. Bhaskaran sir. May I request all the dignitaries on the dais, off the dais to join. I'll request Central Council member, Regional Council members to please join. ICAI is completing 75 years of existence, and that's the face of this book. And let me also recognize and make a mention of Secretary Saurabh Ajmera, who has taken a lot of pain in, compiling this booklet in last 1 month. Thank you, Saurabh bhai. Before I invite chief guest for his address, since the Honorable Chairman of Western India Regional Council, C. Arpit Kabra is here, may I request dynamic young Chairman Arpit to address all of you.
Good afternoon, everyone. Please show some energy. We are back in DTRC. Good afternoon, everyone. Thank you very much. I think before anyone else, let me first thank all the past chairmen of this wonderful region. I think because of whom we've got this legacy program, the most sought after program and the most benchmarked program in the, not only in the region but also in the country, the DTRC. So to all the past chairmen, two of them who are here, I think Nihar bhai and Preeti madam, and of course Murtuza bhai. After lockdown, if at all we are seeing a glory in DTRC, I think this is here this time. So thank you everyone. Please put your hands together for each one of you, for the WRC and for all the chairmen who have worked so hard to make this DTRC a real signature event. I mean, at WRC, every time that we think about, we have to do some regional conferences, sub-regional conferences, some big conferences or national conference on maybe GST, on maybe capital markets or any other program. But one thing that we have to do is the DTRC. Different places that we find, but here we are back in DTRC mode. Thank you to each one of you, because since you all are here, CP committee has made all of these programs physically compulsory, and therefore no more virtual programs. So it's a challenge for all of us to give all that quality, all that programs in physical mode once again. So since you've stepped out, that's a great sign for all of us that yes, we are ready for doing more of such events, and DTRC being one of them. I'm sure with the lineup of speakers, we'll have a great sessions. All 4 Saturdays and 1 Friday this time, DTRC would be served in the best manner possible. I must really thank Drushti Desai, my vice chairman at that time, to structure this entire program. Shardul bhai for guiding us with different people and different all the dignitaries if we were to invite, I think we have to reach out. And most importantly, Nihar bhai, the past president, past chairman, who has always been considerate and always been there for us whenever we wanted. Not to mention Preeti Savla madam, Murtuza bhai, who have always been there at one call away. So thank you very much for setting this up for us. Saurabh Ajmera has really worked very hard. Ketan bhai, the direct tax chairman, has worked very hard to make this book a real success. As again, innovation is at our core. The pride is what we have achieved. Perform, relearn, innovate, distinguish and enrich. These are the 5 pillars that we are working towards throughout the year. In that innovation, this time, this book is also loaded with innovation. Again, we've got a QR code, just like in a bank audit book. And most of the content that you would find, you'll find them on the cloud and easily accessible, easily reproducible, and can be accessed by anyone, everywhere, anywhere. And most importantly, there could be trainings that you could cover through these books. If you were to talk about artificial intelligence, we have a section on artificial intelligence here. People who are talk about chat GPT, let me tell you that there are now new profession which is coming up, new set of professionals coming up, which is chat GPT prompters. In fact, to get things done, you need to even learn how to get things done from artificial intelligence. So I think we have included a section on that. Social audits, thanks to Preeti Savla madam, we've included a section on social audits. I think one person who has fired up this entire idea, small little idea which took birth and now has been put to shape. I think Preeti madam has really worked very hard, and you'll find all of that content also in this book. ESG, Shweta madam, I must mention, she's worked very hard to bring in all and everything about ESG, one of the most looked after, most sought after opportunities. And forensics, of course, and not to mention all our taxes, all our acts, IBC including, all of these in this one simple book, the most researched book. And in fact, let me tell you, to most of the academicians, most of the universities that we have reached out, this year we have launched the project Saptarishi. This project Saptarishi is only about 7 things that we could do with academicians. And one thought that the president has given to all of us, think about 5 years down the line. If this is where we are going, if this is how we are going, do we see a scope of accountants amongst us? If not for accountants, if not for ethical accountants, I think we as chartered accountants will fail to deliver to this growing economy, to this growing entire trillion-dollar economy. So I think one of the basic things that I as a chairman at WRC, at councils, we always think about what is one biggest agenda that we have to work on. Of course, apart from education, apart from training our members, there are 2 big things that we wish to do this year at WRC. One is invest in good accountants. Let's train, let's create, because these are the people who will help our services reach to the end and multiply them throughout. If not for good accountants, I think we as chartered accountants will fail, because we are only 4 lakhs in this big population of 140 crores. So we need to have accountants. And if frauds are the talk of the town, imagine a world where there are ethical accountants. Imagine a world where BCom students or BCom, or any other with new education policy coming in, you are having accountants which are trained on ethics. So anytime a promoter asks an accountant to do a entry here or there or make a payment erstwhile, I think a red flag can be raised by an ethical accountant then and there. If that is deep rooted there, I think these frauds that are happening, and usually when they come out, it's usually late, and then the entire process of penalties and prosecutions get into place, but that doesn't really help the entire erosion that has already taken in terms of human resource, in terms of energy, in terms of money, in terms of trust. I think that all can be avoided through one simple process: invest in accountants and grow ethical accountants, so that this can really be a big boost for us as chartered accountants. Lot of opportunities, lot of areas that we are working on. These are some of the new initiatives at WRC that we have started. For all of you here, I think one of the most exciting part is Gurukul at WRC. If you know anyone at industry, one big banker came and told us that, hey, look, these bankers are now no more chartered accountants, they are just bankers. We want them to understand what are the commonly made errors in financial statements, what are accounting standards, new IFRS and new all of these. For them, we started this project. Sir, you bring in your chartered accountants here and we'll train them in the topics that you want. So if you wish any of these industry members needs training, reach out to us at WRC and we'll be happy to train them. I think all of these activities are going on. One of the biggest things, one of the biggest small little revolution that we've had innovation is our newsletters. I invite all of you to please refer our newsletters, look at our newsletters, and networking zone is something that I would really want each one of you to take advantage of. You need anyone, you need any expertise, you need a partner, you need to make a network firm, anything that you wish to do, just let the networking zone know that, and it will give you visibility to across the country. And this is proven, we've got database to verify that. But anyways, all of that later on. But today, we have a wonderful member, the Honorable ITET member amongst us, Bhaskaran sir. May I request all of you to please put your hands together for the Bhaskaran sir. At very short notice, we had requested him and he agreed to be a part of this signature event. Sir, we are thankful to you, really from bottom of our heart. Thank you for taking accepting our invitation and being here with us. So it's a pleasure.
I am also a chartered
Oh, wonderful. Yes, absolutely. And that's the spirit, sir. And we look forward to that. Thank you very much. And hope you all have a great learning, great DTRC. And for any such more events, feel free to reach out to us. Any suggestions, any feedback, all of us are available throughout the social media. Thank you very much. Have a great time. Thank you.
Thank you, Chairman. May I request the Chairman and the dignitaries on the dais to welcome the Bhaskaran sir with the memento as a mark of our respect towards him. May I request respected Chartered Accountant B.R. Bhaskaran sir to address all of you.
The chairman of WRC of ICAI, Sri Arpit Jagadish Kabra, secretary Sri Saurabh Azmira, treasurer Sri Ketan, past president Sri Nihar Jambusaria, central council member on the dais Sri Piyush Chajat, other central council members and regional council members, my dear professional brothers and sisters, students and other guests, good afternoon to all. Myself being a chartered accountant, it gives me immense pleasure to be the guest of honor of this taxation conference, styled as Direct Taxes Refresher Course and organized by WIRC of ICAI. I understand that this conference is successfully organized for the past 3 decades, and it is most sought after conference by professionals. The reason is obvious. WIRC brings eminent faculties to address the elite group on the issues of contemporary interest in direct taxes. There is a proverb in Tamil, Kattralin Ketrale Nandre, meaning listening to eminent faculties is always better than learning ourselves. Hence, this type of conferences are most successful one. The importance of taxation cannot be overstated. The revenue collection through direct taxes is one of the major sources of income of our country. It is the bedrock for economic development of our country. While the endeavor of the government is to collect maximum tax from the assessees, the endeavor of taxpayers is to pay minimum tax. At this stage, the services of tax professionals come handy to taxpayers. As tax professionals, we will be advising the taxpayers various ways and means to reduce the tax. Hence, we have a great responsibility to maintain highest ethical standards while giving advice on tax laws. There should not be any doubt. Any type of tax planning advice given by you to reduce incidence of tax should be within 4 corners of law. That is, the advice given by you should be within the scope of tax provisions. That is, it should be a case of tax planning and not a case of tax evasion. We must acknowledge the fact that the world is changing rapidly and the landscape is impacted by global events, geopolitical factors, technology, environment concerns, amongst other things. The decisions rendered by high courts and supreme courts also sometimes necessitate the government to bring amendments to tax laws to suit the legislative intentions. Hence, the tax laws undergo frequent changes. It is therefore imperative that we stay informed and current with the latest developments, which will enable us to give right advice on tax matters to our clients. Attending this type of conferences and listening to eminent faculties will help all of us to understand the nuances of various provisions of tax laws. I hope that this conference will enlighten all of us and enrich our knowledge on latest amendments where we need more clarity. Now, regarding ITAT, we are making a very innovative or next step we are planning is, during COVID period, we were hearing the matters through video conferencing. Now, ITAT is planning to make it as a permanent feature. So, ITAT will have hybrid system of hearing the appeals through video conferencing as well as through physical mode. So, video conferencing mode, small matters, you can all join. You must be aware there are more than 5 lakhs appeals are pending before CIT appeals. So, there is huge scope in litigation field. So, I request all the brothers and sisters to think to come to ITAT. It will grow your professional growth. Now, being a judge in ITAT, I would like to narrate a story because all of us are very much interested in hearing your stories. See, two people were going through the forest. It became dark, so they had to rest somewhere. So they went to a cave. They were hungry. So they thought we should have food now. So one fellow has brought 5 chapatis. Another fellow has brought 3 chapatis. When they were about to open their box, a third fellow entered. That fellow said, I am very hungry. If you have any food, please give it to me. I will pay you money. These two fellows said, we have chapatis. For that, we don't require any money. We will share whatever chapati is available. Now, total chapati available is 8. 3 people are there. How to share? Then one fellow gave suggestion, let us break each chapati into 3 pieces. So, 8 into 3, 24 pieces we will get. We will eat 8 pieces each. They agreed, they broke the chapatis into 3 pieces, total 84, each one ate 8 pieces and they went to sleep. Next day morning when they woke up, the third fellow who entered has already left. But he has left 8 gold coins with a piece, thanking both of them and requesting them to divide these gold coins. Now the dispute started. The 3 chapati fellow said, let us divide equally, 4:4. Then the 5 chapati fellow said, no, I brought 5 chapatis, you brought 3 chapatis only, so it should be 5:3. Now the question is 4:4 or 5:3. Both were debating and they finally took the matter to a court, maybe an ITAT member. So the judge heard the matter and finally he said it should be divided into 7:1. 7 gold coins to the person who brought 5 chapatis, 1 gold coin to person who brought 3 chapatis. So that fellow is at last, if he has agreed with that his colleague, you would have got 3 coins. Now judge says only he will get only 1 coin. He could not understand. They asked the judge what is the basis for 7:1. So this story tells one more thing. You cannot be sure of the judgment which he will get from the courts. It can go anyway. Then the judge gave the reasoning why he divided into 7:1. The 5 chapatis were converted into 15 pieces, 5 into 3, 15. So the owner ate 8 pieces, he has given 7 pieces to the guest. The 3 chapati fellow ate 8 pieces, in 3 into 3, 9. He ate 8 pieces and gave only 1. So applying benefit test, 7:1. So if you think deeply, 4:4, 5:3, 7:1, all are right. All are right. If you apply humanity test, 4:4. If you apply broad mathematical test, 5:1. If you apply micro mathematical test, it is 7:1. So decision would depend upon the wisdom of the judge, not according to your desire. So with this short story, I once again congratulate WRC of ICAI for their efforts and dedication in bringing together such a talented and a diverse group of professionals. I wish you all a productive and insightful conference. Thank you.
Respected sir has very clearly indicate he is very capable of interpreting the way the judgment needs to be given. Of course, I'm sure being a senior members at ITIT, we have seen very good decisions from him. And sir, we really appreciate for your valuable time to be here. May I request Secretary C.A. Saurabh Ajmera to propose a very well-deserved vote of thanks to our chief guest, B.R. Bhaskaran sir.
Thank you, Ketan bhai. Good afternoon, one and all. This is the first day of our signature event, DTRC. Little louder. Good afternoon, one and all. Friends, before going to vote of thanks, I want to share some important information to all of you. Friend, by this 1st of July, we are entering towards our 75th year of our existence as a ICAI. We have 168 branches. We have more than 8 lakh CA students. We have approximately 4 lakh chartered accountant members. Globally, we have presence in 47 countries. So feel the legacy which we have. And to celebrate this legacy year, we are planning lots of activities at WRC that will be starting from 1st of July to February. So I request each one of you, please be active in each and every activity which we are sharing with you. Apart from that, friends, we are hosting a very big program in startup space at Geo World Center, Geo Convention Center, you can say. Being the startup committee chairman at WRC, it's my responsibility that I should highlight some of the aspects. So in startups fair, we are inviting more than 200 exhibitors that include large portfolio company exhibitions and incubation center exhibition also. We have more than 100 investor pool, Shark Tank, and almost we are expecting 10,000 participants over there. So my request each one of you, please be active. If you want to join, please register yourself. And that will be very, very useful program to understand the whole startup ecosystem. Moving towards the vote of thanks, it's my great pleasure to propose vote of thanks to Bhaskaran sir for such a great program, you can say signature program of DTRC. Sir, on such a short notice, you have given your approval and join us over here, sparing your valuable time. A big round of applause for Bhaskaran sir. On behalf of WRC, I thank you, sir, from bottom of my heart. I thank Nihar bhai, past president, sir. I thank Piyush Chajerji, vice chairman of Direct Tax Committee of ICAI. And I thank our Central Council member, Priti Saula ma'am, to join us over here. I thank all my regional council colleagues and past regional council member. Thank you, everyone. Thank you, everyone, for joining over here. Thank you.
Moving towards the first technical session of the day, we have, respected past President Nihar Jambusaria sir as a speaker. May I once again request Secretary C.A. Saurabh Ajmera to introduce the worthy speaker for the first session. Over to you, Saurabh.
It's my great privilege to introduce such a great personality, our own past president, C.A. Nihar Jambusaria sir. I think there is no need of introduction for our own Nihar bhai, so I will be in Crips only. C.A. Nihar and Jambusaria sir is a qualified chartered accountant in 1984 and practicing from last 27 years. He is designated as a senior vice president in Reliance Industry Limited in 2011 and served till April 2020. Now providing consultancy to Reliance Group, an organization of private and public sectors. He was the president of Institute of Chartered Accountant of India from 21 to 22. He was the chairman of Western Region, WIRC, Western India Regional Council of the Institute of Chartered Accountant of India, ICAI, from 2004 to 2006. He was the designated as a vice president of SAFA in 2022, designated as president of SAFA for 2023. With this, I request to have a big round of applause for Nihar sir.
I'll request dignitaries to join for the giving memento as a mark of our respect towards Nihar, sir. I also recognize the presence of dynamic Central Council member Umesh Sharma sir from Aurangabad, expert in GST. Thank you, Umesh sir, for blessing the occasion. I'll request Nihar bhai to take up the charge.
Good afternoon, everybody. Chairman of the Western India Regional Council, C. Arpit Kabra, Secretary Saurabh, Treasurer Ketan, the Central Council members, C.A. Preeti Savla, C.A. Umesh Sharma, C.A. Piyush Chhajed, who is also the Vice Chairperson of the Direct Tax Committee at the Center, the past Chairman, C.A. Murtuza, the other regional council members, past regional council members, and on top of everybody, today's chief guest, C.A. Bhaskaranji, who gave us a very good story. And I think in my today's presentation, perhaps the last issue that I have taken as to how to compute capital gain in the case of a firm which is reconstituted. Perhaps you may ask the same question, how these calculations are derived, whether 5:3 or 4:4 or 7:1. And perhaps the only answer is, it all depends upon those who draft the rule and finally those who interpret these rules when it comes to appeal. In fact, once again, let me mention with this direct tax refresher course, even my memories go back to 2001, when for the first time I entered WIRC, and then in those days, DTRC used to be conducted in Patkar Hall. Then it was shifted to Birla Matusri, and now it is shifted to Yogi. The chairman of Western India Regional Council was afraid that after 2 years we are organizing this course, and the members are used to attending this course online, so whether they will come offline. I think advantages of offline attending are very distinct, and the opportunity that you get here to interact with each other and many times solve many of our issues by discussing with each other, that opportunity is not available online. It is available only when you physically meet. So I appreciate that you have restarted DTRC, and it has started with decent attendance of members. Even here I see that most of the members are senior, and it looks like many young members are either going to industry or they are taking up the newer areas of practice like sustainability, information technology, forensics, and so many new areas. The fact remains that direct tax will remain the center of attraction as long as in every budget we find 100 amendments. And today I was told that I should deal with some important amendments in capital gains. So first I thought whether there would be enough amendments to cover in a session. But when I started preparing these slides, I thought the number of amendments are good enough. And when we talk about capital gains, let us recall, because there are so many seniors who would remember that many years back, capital gain was considered to be a head of income which was to be used by the government sparingly. Because if you go by accounting principles, capital receipts should not be taxable generally, because these capital receipts build further capital for the country. But as time passed, not only India, but every country of the world has started taxing capital gain extensively, the manner in which India does. And if we look at the amendments, perhaps the government is trying to find out every area of tax planning which is possible under the existing provisions. Year after year, they plug not only the loopholes, but even the genuine areas of tax planning. So today, let us start with these amendments. Let us look at what they have tried to amend and what they have tried to achieve, and what care we need to take when we deal with these amendments while preparing the returns of clients, while doing the tax planning for the clients, and also think of what would be the possible interpretations when these matters come up before the assessing authorities or appellate authorities. So with that eye, let us look at every provision and try to understand what are these amendments. So first, let us start with a comparatively easier, simple amendment that SEBI, under its regulatory framework, came out with a detailed regulations for spot trading in gold on existing stock exchanges through the instrument of electronic gold receipts, EGR. And to facilitate this amendment has been brought out. And it will really facilitate converting gold into EGR, dealing with it extensively on stock exchanges, and whenever required, reconvert it into physical gold. So first, let us look at some issues that may arise. Then we will look at the amendment and see what are the answers to the issues. So this amendment is effective from assessment year 2024-25, and it deals with conversion of physical gold into instrument, EGR, and when required, conversion of, or rather reconversion of EGR into gold. So what they have tried to do is exempt this conversion. And let us see the implications of exempting this conversion from the meaning of transfer. So if EGR is sold, what will be the period of holding could be one issue. Let us see whether it is addressed. If EGR is again converted into gold, what will be its period of holding? Again, let us look at the amendment, and whether period of holding of gold originally held will be included when finally you sell the physical gold. So let us first look at the amendments. They introduced clause 7D in section 47 to promote the concept of electronic gold. It is proposed to exclude conversion of gold into the instrument which can be dealt with, that is EGR, and vice versa by a SEBI registered vault manager. So any Tom, Dick and Harry cannot issue EGR. It is only SEBI regulated vault manager who can accept your physical gold and issue EGR. And if it is done through vault manager, then this conversion and reconversion into gold both are not to be regarded as transfer. So any transfer of gold by conversion into EGR or reconversion of EGR into gold will not be regarded as transfer. Now, regarding period of holding, let us see what is the provision. The period of holding of gold received on conversion of EGR shall include the period of holding of EGR. Sorry, I missed one line. The period of holding of EGR will include the period of holding of gold originally acquired by the SSE. So when you receive EGR, and then you start dealing with it on stock exchange. Suppose gold was held by you for 5 years, then you converted it into EGR, and then this EGR is sold. What will be the period of holding? It will be 5 years for which gold was held, and for whatever period you held EGR, total of these two. That will be the period of holding. What will be the period of holding of gold received when you convert EGR into gold? Because you may require gold for various purposes. You may deal with EGR on stock exchanges. After some years, suppose there is marriage in family, there is some occasion, and you require physical gold. Then you can sell or you can convert EGR into physical gold. When you acquire this physical gold on conversion of EGR, what will be the period of holding? So again, section 242A, explanation 1, clause HI, which has been added by the last Finance Act. It provides that period of holding of EGR will be added to the period of holding of gold when it is reconverted. Now here one question will arise. Suppose I give a simple example, and let us take two examples with two different categories of transactions. One where an individual converted his gold into EGR. Gold was held for 5 years, after that it was converted into EGR. He holds EGR for 2 years, after that he converts EGR again into gold. He holds this reconverted gold for another 1 year and then sells it. What will be the period of holding of this gold? Now, if you go by what is there in clause HI, then perhaps you will get the answer. 2 years of holding of EGR and 1 year after reconversion of holding of gold, that is 3 years. But according to me, this is not correct answer. In fact, 5 years for which you first held the original gold should also be added to this. Now, one may say that clause HI does not specifically provide that period of holding of previous gold is also to be added. So you go by logic. If you convert gold into EGR, clause HI says that period of holding of gold is to be added to the period of holding of EGR. So for this EGR, which you held for 2 years, the period of holding is 7 years. Now, if you reconvert this EGR, if the period of holding of EGR is 7 years, then naturally it is to be added when you reconvert it into gold. And therefore, in this case, the period of holding will be 8 years. And we have, in spite of very specific mention in clause HI, we have in the past case laws where in section 242 it is not specifically provided that if I receive any asset as gift from somebody, or if I receive any asset as a successor from my predecessor, whether the period of holding of previous owner should be added or not. Cost of acquisition of previous owner is to be added. And in the case of Puspa Sofat, which is the oldest decision and some of the seniors would remember, Chandigarh Tribunal, 81 ITD, page 1. And thereafter, Bombay High Court decision in the case of Manjula Shah, where Bombay High Court confirmed that even in the absence of this provision, where you say that the cost of acquisition of previous owner is to be considered, even the period of holding is also to be considered. So the same logic will apply, and you will be able to get for the reconverted gold the period starting from holding of the original gold. Now let us take another example with another category of transactions. A person converted gold held for 5 years into EGR. Then he sold this EGR in the market after 2 years. So the period of holding of this EGR was 7 years. Then he again purchased DGR from the market, held it for 1 year and converted into gold. In this case, he will not get period of holding of that original gold because he sold EGR and he exited investment from EGR. He acquired fresh EGR and then it was converted into gold. So when this fresh EGR was purchased and held for 1 year, this 1 year will be added to the period of holding of converted gold. So that is how this provision will work. In fact, with the past case laws, the position becomes simpler and one may follow this pattern of computing the period of holding. Another important amendment where there are 1 or 2 points which are very important. Let us first look at the amendments. Let us first go to the logic. The government thought, of course because of feedback from the department, that the exemption which was designed to give relief to a person who sells residential house property and acquires another house property, the capital gain should not be charged to tax if within the prescribed period another house is acquired. And this was to promote house building activity as well as facilitate people to acquire new house where old house is either it has become old or it is inadequate and person wants to acquire a new house. So this exemption was provided. We are all aware of this provision. Apart from this, there was another provision that suppose you hold any other capital asset other than a residential house for long term, it is a long term capital asset. You sell it and you acquire a residential house. For example, a person held jewelry for 10 years and after that sold it in the market and used the sales proceeds to acquire a residential house. Exemption is provided under section 54F. And you know this scheme. In the case of sale of a long-term capital asset being residential house, and you have acquired another house, you are required to invest capital gain in the new house. Entire gain will be exempt under the old provisions. If you sell any other long-term capital asset like jewelry and acquire residential house, only investment of capital gain is not enough. You are required to invest net value of consideration. Net value of consideration is full consideration minus expenditure on transfer. You are required to invest the full amount in residential house. Then the entire capital gain is exempt if you have invested entire net consideration. Now they say that people have misused these exemptions to acquire one house, hold it for 3 years, 2 years, whatever is the period for becoming long term. Then they sell it, acquire another house. Again, they sell this house after the prescribed period, acquire another house. They invest huge money in this and the entire capital gain is exempted. Year after year, real estate prices go up. So we want to put some limit. What is a reasonable limit to invest in residential house? And they thought that if this exemption is restricted to 10 crores, it is a good enough amount for any person to have a residential house. So now they have introduced that in the case of section 54, and we will discuss both separately, in the case of sale of one residential house and acquisition of another residential house, if the cost of the new house exceeds 10 crores, the cost of the new house should be taken at 10 crore. So if we take a simple example where old house was sold for 20 crore, the index cost of acquisition of that house was 5 crore and 15 crore is long-term capital gain. You invest entire 15 crore in the new house, the cost of new house will be considered to be only 10 crores and therefore you will get exemption of 10 crore, balance 5 crore will be taxable. This is simple. Now when it comes to section 54, whether they are achieving the object of restricting exemption to 10 crore or they are further restricting the exemption. So let us look at an example. In the case of section 54, where the net consideration, gold was sold after holding for more than 3 years for 15 crore and no expenditure was incurred. So net consideration is 15 crore. Index cost is 5 crore. 10 crore is long-term capital gain. Under the existing provision, if you invest 15 crore in residential house, entire 10 crore will be exempt. But under the new provision, what they have said, that the cost of new house, cost of residential house will be deemed to be only 10 crore in this case. If it is deemed to be 10 crore, then calculation will be like this. Long-term capital gain is 10 crore multiplied by net consideration invested in residential house. So you have actually invested 15 crore, but it is kept at 10 crore divided by actual net consideration 15 crore. So the exemption will be only 6 crore 66 lakh 667. So this is, I think, what they did not want to achieve. Their target was to give exemption up to 10 crore. But now they will end up giving exemption of lesser amount in the case of section 54F. In fact, this was pointed out when they introduced the provision in the finance bill. Many organizations, including ICAI, represented that you should not do this even for 54F. You should allow exemption up to 10 crore and design the formula in that manner. But they have not considered it. So this is the position that will go after the amendment. Then we come to another amendment, market linked debentures. Here also there are one or two issues, but let us see, this provision does not look very complicated. We have Sunil Bhai Kothari here, who has dealt with securities extensively. So if I am missing out any issue, you may point out. But with my understanding, whatever issues are there, I have listed. So first let us understand this provision. This is a hybrid security. Market linked debenture. It combines the feature of debt security and exchange traded derivatives issued through private placement, and these are listed on stock exchanges. So because they are listed on stock exchanges, under the existing provisions or the old provisions, we used to compute capital gain by reducing the actual cost of debentures without indexing, and we used to pay 10% tax, which was more beneficial. Even otherwise on debentures, indexation is not allowed, but we used to pay 10% tax. Now they have introduced section 50AA. So what does it provide? As these securities are in the nature of derivatives, this new section provides that the capital gain on transfer or redemption or maturity of these securities shall be deemed to be short-term capital gain with effect from assessment year 24-25. So the moment it is deemed to be short-term capital gain, it will be taxed at full rate. So now that 10% concessional rate benefit will not be available, and it will be taxable for at full rate of tax. Now see what issue may arise. Only cost of acquisition and expenditure on transfer will be allowed, which was allowed earlier also. Only there is difference in the rate of tax. The issue that arises is that suppose these debentures were held for more than 1 year, And if I invest this short-term capital gain in securities specified in section 54 EC, whether I can claim exemption under 54 EC. Earlier we had a misconception that once the capital gain is treated as short-term capital gain, exemption is not allowable because section 54 AC is worded in such a way that it can create confusion. It says, now let us see what is the language in section 54 EC. It says that if an asset which is transferred is a long-term capital asset, and if you invest the gain in 54 EC securities, you are entitled to exemption. Section 50 AA says, in spite of the debenture being a long-term capital asset, in spite of holding it for more than 1 year, the gain will be deemed to be short-term capital gain. But section 242A, which defines short-term capital asset, is not amended. This section does not say that where capital gain is regarded as short-term capital gain, even the asset will be regarded as short-term capital asset. No, there is no amendment. So the asset is the asset is long-term capital asset, but gain will be deemed to be short-term capital gain. Now 54 EC provides exemption provided the asset transferred is long-term capital asset. And therefore exemption under 54 EC should be available in this case. We have case laws in the case of other long-term capital assets also, which are deemed to be short-term. Even on depreciable asset also, there are some case laws which say that if it was held for more than 2 years, and although it is part of block, section 50 C only says that it is to be deemed to be short-term capital gain, but the asset remains long-term capital asset. Therefore, you can invest the gain and claim the exemption. That position will continue. Then one more issue which you may consider is that suppose these debentures were held by a company and this company gets merged with another company. And in the case of merger, you know, section 47 does not regard transfer of all these assets as transfer. It is not regarded as transfer. Will section 50 AA still apply? It will not apply, because if the transaction is not regarded as transfer, there is no question of deeming it as long-term capital gain. No capital gain arises, and therefore nothing will be taxable. So where a transfer is exempt under section 47, section 50 AA will not override section 47. 47 will prevail. Then we go to another amendment which is a minor one to align with section 194 IC. But principally we may discuss, there is one point which may come out. See, in the case of joint development agreement, section 45, subsection 5A provides that for computing capital gains from transfer of capital asset being land or building or both under a joint development agreement, full value of consideration shall be taken as the stamp duty value of the share of the SSE as increased by the consideration received in cash. So first let us understand what is sought to be achieved. When you enter into joint development agreement and transfer your property to the developer or to the society, under JDA you are given some share in the newly constructed property, plus he may give some amount, lump sum amount, by transferring that amount to your bank account or even in cash. Now this provision is little crudely drafted. It says that full value of consideration shall be fair market value of the property that you receive as your share, plus the consideration which is received in cash. Then there is a provision for TDS, that the person who gives you this property and the cash is supposed to deduct tax at source. So there they provided that for the purpose of deduction of tax at source, full value of consideration shall be taken as the stamp duty value of the share of the SSE as increased by consideration received in cash or by check or by draft or any other mode. So for the purpose of TDS, even if you receive consideration by check, draft or bank transfer, it is included. And section 45(5)(a) use the word only consideration received in cash. So many of the taxpayers interpreted that if consideration is received by bank transfer or by bank draft, it is not to be considered as part of full value of consideration. I don't think this is the correct interpretation. But now they are making the amendment with prospective effect from assessment year 24-25. So taxpayers have started thinking that our argument will get strengthened. Otherwise, they would have clarified the situation. Instead of that, they are bringing amendment with effect from prospective date. So the old position, we can still argue. I doubt whether it can be argued. The correct interpretation is cash includes even amount received by check or bank transfer. So after this, we cherished BC Srinivasa Setty 128 ITR 294. Right from my student days, we were quoting this judgment even in exam when a question was asked. So originally, in this case, the Supreme Court held that there cannot be any capital gain tax if the computation mechanism under section 48 fails. So in that case, goodwill of the business was transferred. And it was self-generated business, goodwill. So argument was that what is the cost of this goodwill, self-generated goodwill? Department said it is nil. SSE said no, it is not nil. It has some cost. My honesty, my hard work, training of employees, all these has built goodwill. But you can't put precise value to goodwill. And if you can't put precise value, the computation mechanism fails and therefore capital gain is not taxable. Supreme Court accepted this argument. We enjoyed and cherished it, quoted in so many cases. Then in installments, they kept on revising or amending the provision of section 55(1)(b), 55(2)(b), the meaning of cost of improvement and meaning of cost of acquisition, where they introduced first that cost of self-generated goodwill of the business shall be taken as nil. So in the case of goodwill of the business, whenever it was self-generated, the full value of consideration was capital gain. Then we, the professionals, particularly chartered accountants, took advantage of the word business. And we said that in our case, it is goodwill of the profession. And therefore, we are still covered by BC Srinivasa Setty. So later on, they added the word or profession. Then they introduced some more items of assets like tenancy rights, stage carriage permits, loom hours. But they did not exhaustively define that all intangible assets which are self-generated or whose cost cannot be determined shall be taken as nil. And even rights were not fully covered. Tenancy rights, loom hours, stage carriage permits, a few of them were covered. Now they are covered. Now they are amending and providing that cost of improvement and cost of acquisition shall include any intangible asset for that purpose or any right which is self-generated, its cost shall be taken at nil. And therefore, now it appears that almost every kind of right, every kind of intangible asset would be covered, but there are one or two rights regarding which we can still have debate whether they are covered or not. So let us look at those rights. One is right to sue. When somebody has done default and you have a right to sue that person, suppose you receive a compensation and give up that right to sue, whether there is transfer of right. Now here I think in many of the old judgments a view was taken that right to sue is given by constitution to all citizens of the country. It is not personal right. And therefore one cannot say that you have transferred that right. Then the question is, when you give up your right to sue, whether the receipt is capital or revenue. If it is of capital nature and if it does not amount to transfer of a capital asset, because right to sue is general, then whether what you receive is taxable. That is one question. Now I think regarding TDR and FSI, probably the issue seems to have been resolved unless somebody has different opinion. We remember we have decisions in the case of Maheshwar 2 Cooperative Housing Society, Sambhaji Nagar Cooperative Housing Society. I have taken two illustrations. There are a few other judgments where it was held that in the case of a society or in the case of any individual owner, where there was original of FSI which was then enhanced by municipal corporation, the additional FSI which was added by BMC or municipal corporation, it did not have any cost which can be determined. And in these judgments, the argument of BC Srinivasa Setty was accepted, that as the cost cannot be determined, the additional FSI is received by virtue of holding that land for certain number of years. In some cases 15%, 20% or 1:1 was raised to 1:2, 1:4. So additional FSI was added by BMC. Now if this additional FSI is sold to a developer, can one say that cost is not determinable and therefore capital gain is not taxable? And in these judgments, it was held that yes, it is not taxable. Now, all kinds of rights are incorporated in 55(1)(b) and 55(2)(a). And it has been provided that in the case of intangible assets and any right whose cost cannot be determined as they are self-generated, it should be taken as nil. So the capital gain should be taxable. There were many who were exploring that in the case of redevelopment of properties, in the case of transfer for development, can one still take some corpus donation, some payment for avoiding harassment, and still argue that it is a capital receipt? I think it is a disputable matter, and perhaps there are some judgments also. Even Mumbai Tribunal has held that this is in the nature of full value of consideration only. So unless you are unable to determine cost of the additional FSI, even these payments, some tribunals have considered they are part of your consideration for transfer of additional FSI and should be added to full value of consideration. I think in the case of those owners of properties who hold residential houses, even in the case of redevelopment, joint development, you are able to claim exemption under section 54. And if you are able to claim full exemption, I think this argument of separating harassment compensation corpus payment to be treated as pure capital receipt, you can leave and add it in full value of consideration and claim exemption under those sections. That would be more safe than arguing that they are capital receipts. Again, there are one or two categories of rights where you can still have debate whether its cost will be considered to be nil. One is license, another is voting right. I think license is personal, and their nil cost will be taken as per the new provision. But voting right, again, whether it is arguable, according to me, no, it is also a personal right. And right to compensation under accident insurance policy. I think again there are judgments where it is held that this is compensation indemnity. A person is indemnified, you have not exercised right. It is a contract of indemnity rather than generating any right. So here you can still claim that whatever you have received under accident insurance policy is a capital receipt. One other question which is being discussed is, suppose there is a slump sale of the entire undertaking and it contains some intangible assets also. So all the assets are sold for a slump price. Are these intangible assets to be separated and some allocation of consideration can be done to intangible assets separately? According to me, no. Once it is a slump sale, it will go by slump sale formula. Entire amount received is full value of consideration. You reduce the cost of the undertaking, compute in the manner it is provided, and the capital gain will be taxable. You can't separate intangible asset. You can't separate full value of consideration for intangible asset. You can't say its cost is nil and therefore the entire amount is taxable. So even the department cannot do it, and it is part of consideration for the entire set of assets and liabilities. Now, again here one question arises that in the past perhaps all of us have enjoyed these provisions, that if property is acquired with borrowed fund, the interest which is paid, it is claimed as deduction under section 24 in computing income from house property. It was claimed under chapter 6A. It was allowable under section 80C. And thirdly, when this property was sold, the taxpayers added interest to the cost of the property and claimed it as part of cost of acquisition or cost of improvement. Section 24 deduction, chapter 6A deduction are fine. But whether after the property is put to use, even on principles of capital and revenue, this question was always debated whether you can add this interest to the cost of the property, either as cost of acquisition or as cost of improvement, whether you can do it. But after that, Chennai Tribunal in the case of Ram Abrahaman held that apart from claiming deduction under 24, under chapter 6A, you can also claim deduction by adding this interest in the cost of the property when it is sold. So this was a specific judgment of Chennai Tribunal. Now it is being provided that if you have claimed interest as deduction under section 24, then you can't claim it as part of cost of the asset, cost of acquisition or cost of improvement, specifically provided now. Does this give strength? Again, this amendment is prospective. Does this give strength to the argument that earlier what I was doing was correct? There is a Chennai Tribunal judgment. For old cases, one may keep arguing, but henceforth this will be not available. I was told I have to complete at 3:45. There is still some time. In fact, this slide was added at the request of somebody only to explain the calculation. Actually, this amendment came through the Finance Act 21 with effect from assessment year 2021-22. So it is not the amendment done by the Finance Act 23. But I was told that because under the guidelines issued by CBDT, write that circular, the calculations are not very clearly understandable. You take it up and discuss here, so I have taken. So let us take this provision first. If assuming that it is not very fresh in mind, I will first look at the provisions and then we will discuss the example given in the guidelines. Now you know that when there is reconstitution in the firm or AOP or BOI, what the retiring partner gets, there was a debate and it was successfully argued that nothing is taxable as capital gain. Not only that, there were many who planned and acquired property in a firm, became partner, admitted some partners and then retired, and in that manner transferred the property. And it was not getting taxed. So this provision was introduced with that intention that on reconstitution, when a partner, because otherwise under the general law firm and partners are one and the same and there is no transfer. What you receive is your own right and there is no transfer by firm to the partner. So these provisions were introduced. So first in the Finance Bill 21, at that time because my term was going on at the institute, I was not pursuing these provisions. But then later, because the request was made, I saw the whole history and tried to find out how this was introduced and what amendments and how guideline was issued. So first of all, in the Finance Bill, subsection 4 was sought to be amended and subsection 4A was sought to be introduced. But some lawyers and solicitors pointed out that if there is no provision in section 224 or section 9 in the definition of income or income is not deemed to accrue or arise, straight away you cannot make provision in section 45.4 and 45.4a and tax this receipt because basically firm and partners are the same. So then they introduce section 9b in income deemed to accrue or arise in India, so that this receipt becomes taxable. Now see what is sought to be done. In fact, when a partner retires or a new partner is admitted and there is reshuffle of the profit sharing ratio of old partners, or without admission in the existing firm there is change in profit sharing ratio, there is deemed to be a transfer of capital asset by firm to partner. I have taken only one example, although 3 examples are given in the guidelines to illustrate the principle, and then the other 2 can be understood. Section 9b provides that first of all, where a specified person receives during the previous year any capital asset or stock in trade or both on dissolution or reconstitution of the specified entity, specified entities shall be deemed to have transferred capital asset or stock to the specified person. So what is specified entity? It is firm or AOP or BOI. Who is specified person? In the case of firm, partner. In the case of AOP or BOI, member. So where specified person, let us take example of a firm. So I will say firm. Where a firm specified person, so partner. Where a partner receives during the previous year any capital asset or stock or both on dissolution or reconstitution of the firm, the firm will be deemed to have transferred capital asset or stock to the partner, and the capital gain arising out of it will be taxable. So capital gain or profit on deemed transfer becomes taxable in the hands of the firm. It is not taxable in the hands of partner. It is taxable in the hands of firm. It is to be computed as per guidelines issued by CBDT. So in the guidelines for 9B, let us take one example and see what CBDT has provided. Then we will come to 45.4. So this we will come to little later. This example pertains to section 9B. So here there were 3 partners in the firm, A, B and C, and the firm is FR. Each partner's capital balance was 10 lakhs on the date of transfer of asset. Each partner's capital balance. Firm owns 3 pieces of land, S, T and U, and the book value of each land is 10 lakhs in the books of account. A wants to exit. Out of the 3 partners, A wants to exit. He wants to retire. And the valuation of 3 lands as per Rule 11U is for S and T, the fair value is 70 lakhs. And for land U, the fair value is 50 lakhs. A on his retirement is given by the firm 11 lakhs as money, cash or by bank. And land U plus land U is given to him on his retirement. Now section 9B computation of income, how it will be made. Now provision is that the firm will be deemed to have transferred this land to the partner. Money not to be considered. Any capital asset or stock in trade. Here stock in trade is not transferred. Only capital asset is transferred. The firm is deemed to have transferred this land to the partner and accordingly compute capital gain. So how is it computed? The fair market value of land U is 50 lakhs as we have seen earlier. It is 50 lakhs and the index cost of U, the book value is 10 lakhs but indexed cost is given, it is 15 lakhs. So deemed capital gain is 35 lakhs. And because index cost is taken, naturally the asset is long term. So this 35 lakhs is long term capital gain. Let us for the time being forget about education cess or surcharge. 20% is the rate at which it would be taxed. So 7 lakhs is the long term capital gain tax that the firm has to pay. And for the future, because firm is paying tax here, in the hands of this retiring partner A, the cost of acquisition of this land will be taken at 50 lakhs. Here on full value of consideration of 50 lakhs, the firm is paying tax, so partner's cost of acquisition will be 50 lakhs. I think this is simple to understand and one may digest, but the other part, let us look at it. At first sight, it would look like utter nonsense that partner is retiring, land is given to him, and 2 times we are computing capital gain. A complicated exercise is suggested in the guideline, but there is some logic given by them. The opinion is that this will work. Rule 8AA, 8AB. So first let us go back to section 45.4, where this provision has been incorporated and formula is given. So where a specified person, so in our example partner, where a partner receives any money or capital asset, because this is 45.4 capital gain provision, stock in trade will not come here, it will fall under section 28. And gain, if stock is transferred, fair value of stock minus its cost will be treated as business income in the hands of the firm under section 9B. But here no stock is transferred. And for capital asset, 45 will provide only for capital asset. Where a partner receives any money or capital asset, or both from a specified entity, that is firm, on reconstitution of such entity, any profit from such receipt by the partner is chargeable to capital gains tax, and gain to be computed as under. The formula is given in this section. A is equal to B plus C minus D, where A is capital gain, B is money received, C is fair market value of capital asset received by the specified person, and D is the amount of capital in the firm. And it is made clear that the balance in the capital account of the partner is to be taken without considering any revaluation of asset that may have been done in the past. So deduction is given for capital balance, and the difference is capital gain. So now in this example, money received is 11 lakhs. You have seen money received is 11 lakhs. Fair value of asset received is 50 lakhs. So 11 lakhs plus 50 lakhs. And minus what you will do is capital balance. So apparently you may feel that capital balance is 10 lakhs. It is given here. Capital balance is 10 lakhs. But then here, because the capital gain would be taxed double time, and in order to see that you don't tax it 2 times, and in future you get benefit of this tax which you are paying here, an adjustment is given in the guidelines. See, guideline is given in rule 8AA and 8AB, where they give the formula for computation of deduction for capital balance also. So let us see what adjustments are done. Now, net book profit on transfer of land, net book profit is how much? See, the capital gain is 35 lakhs because we have taken index cost of acquisition of 10 lakhs. But book profit is 50 lakhs minus 10 lakhs, 40 lakhs, and we have paid 7 lakhs of capital gain tax also. So minus that 7 lakhs, 50 minus 10 minus 7. 33 lakhs is the balance. Book value of asset, again the value of the asset, fair market value, less book value, less tax paid. 33 lakhs is the balance. Now this 33 lakhs, because you have paid tax on that 35 lakhs gain, the guideline says that this 33 lakhs is to be distributed among the 3 partners in their profit sharing ratio. In our example, 3 partners have equal profit sharing ratio. So 33 lakhs divided by 3, 11 lakhs to be credited to the capital account of each partner. Now when you compute capital gain under 45(4), the capital balance that is to be reduced is as per books before retirement plus this 11 lakhs which is allocated to A. So what will be the capital gain? What he has received is 11 lakhs plus 50 lakhs of land, 61 lakhs minus 21 lakhs is capital balance. So 40 lakhs is the long-term capital gain on which firm will pay tax again at the rate of 20%. It is long-term capital asset. So now it says that, see, in the case of this land, the firm is paying tax at this stage, 50 lakhs minus 10 lakhs, 40 lakhs. That is the difference in the value. So these 40 lakhs should again be allocated to the remaining assets. In our example, it is simple, only two lands are left. S and T, U is taken by the retiring partner. S and T, two lands are left. So 40 lakhs of this profit, you allocate between these two lands, between these two assets which are left in the ratio of their fair value. Again, their fair value is the same. Their book value is 10 lakhs, 10 lakhs. Their fair value is 70 lakhs, 70 lakhs. So if you divide in equal ratio, 20 lakhs to each land. And the guideline provides that in future when these two lands will be sold, 20 lakhs will be reduced from full value of consideration of each land when it is sold or transferred in future. So this is the formula that they are giving. And in section 45.4, they have made it complicated that first you compute capital gain as per the formula, where even the capital balance of partner is to be enhanced by the book profit in his profit sharing ratio. So he gets more deduction. Firm has paid tax on 2 occasions. In future, he will get deduction of 50 lakhs as cost of acquisition. In the same manner, the remaining partners will also get deduction in the case of these two lands by reducing 20 lakhs from full value of consideration, on which on deemed transfer the firm is paying tax. So this is how it will work. And I was mentioning when Bhaskarji mentioned that in that example of 5 rotis, 5 chapatis and 3 chapatis, whether the gold coins should be distributed in the ratio of 5:3 or 4:4 or 7:1, and the judge in his own way calculated 7:1 ratio. The persons who have drafted these rules and the guidelines have computed or provided this guideline in their own way. So there are different ways which even we may have. The provision is introduced in such a way that some element of judgment had to go in the calculation of this formula. But overall, if you see in the long term, the loss for double payment of tax will be made good. Now what is emerging out of this is that this book profit you will account for. 33 lakhs you will credit to the capital account of the partners. But the 20 lakhs and 20 lakhs, which is to be allocated to the two assets, in this example in equal ratio, and in future it is to be reduced from full value of consideration, it will not be accounted for in the books of account. So the firm will have to keep record that these 20 lakhs in the case of each land stands unadjusted, and whenever this land is sold, it is transferred in future, we have to claim reduction of 20 lakhs from full value of consideration. You can imagine if this land is transferred after another 5 years or 10 years, when the firm's accountant and chartered accountant both have changed. At that time, who will remember that this is to be reduced from full value of consideration? Unless you make use of information technology extensively and keep this record and keep a command that this note is to be carried forward to each subsequent year, so that when you prepare the computation of income, it will flag that this remains unadjusted. Carry it forward every time the land remains on the last day of the previous year with the firm. Year in which it is sold, claim the deduction from a full value of consideration and get rid of it. So this is how it has been drafted. I think all those who want to practice income tax, there is enough work for us. Provisions like this will keep coming. Every year in capital gain itself, there are 10 amendments. So overall, there are 100 amendments. So we will keep learning, we will keep earning, and this practice will go on. One cannot say that tax practice will come to an end with the emergence of ChatGPT. Because after all, see, ChatGPT cannot imagine somebody will design formula in this manner. And even the CEO of ChatGPT the day before yesterday gave a statement that when he has to take decision, he does not depend on solution given by ChatGPT fully. He applies his mind. Day before yesterday, it is in Economic Times. So you can imagine that this practice will continue. Only compliance functions may get shifted to information technology, but advisory, litigation, everything will remain with human beings. I don't think we will see robots going and arguing case in tribunal before Bhaskaranji or anybody else. With this, I must thank Chairman of the Direct Tax Committee, Chairman WIRC, and everybody who thought of my name to give me the opportunity of discussing this topic with you. It gave me the opportunity to study also. Thank you so much for patient hearing.
Thank you so much. As our chairman says, he is a Sachin Tendulkar of taxation. And sir, taking clue from you, I'm sure we all practitioner will apply our mind and will not simply follow the chat GPT or any other ready-made softwares for that matter. With this, we are moving towards the end of first technical session, and we'll straightway, without breaking, start with the second technical session. The high tea will be served post second session at the end of this program. So please have a high tea before you leave the venue. With this, let me request Secretary Western India Regional Council CA Saurabh Ajmera to propose a very well-deserved vote of thanks to sir.
Thank you, Ketan bhai. What a wonderful session we had. Let's have a big round of applause for Nihar sir. Sir, the way you explained all the provision related to capital gain is highly grateful and great in terms of knowledge sharing. So from bottom of my heart, on behalf of WRC, thank you very much for sparing your valuable time and join us over here. You are the personality who are always available to help all of us. Thank you, sir.
May I request my regional council colleague CA Ankit Rathi and CA Gautam Lat to take over the second proceedings of the second session.
Friends, I request everyone please be seated. We are immediately starting our next session and
I request Central Council member CA Umesh Sharma sir kindly escort our today's speaker Yogesh sir on the dais. Yogesh Thar, sir. Very good afternoon, members. It's my immense pleasure to be here and welcome you all again second technical sessions that is conversion of firms, companies, proprietorship concerns and other form of restructuring. Thank you. At the outset, let me welcome on dais Central Council member CA Umesh sir, our today speaker Yogesh Thar sir and my colleague in council Gautam bhai. Welcome you all. Let me also again welcome our today's speaker, sir. Thank you so much, sir, for accepting our invitation and being agreed to share your knowledge and bless the dice. Thank you so much, sir. Before we formally start the today proceeding, I request Umesh, sir, kindly present opening remark.
Thank you, Ankit. Good afternoon. This is a session before your refreshment, and the name is Refresher Course, and we are getting refreshed by knowledge. Thanks, Yogesh sir, for his expertise in this subject. The subject is very important subject, conversion of firms, companies, proprietary concerns, and other forms of restructuring. and this is a direct tax refresher course. My passion is a GST. I am a wrong person on the dais, but yes, being a practicing chartered accountant, we have to look into 360-degree whenever we do such transactions. And there is a reference in GST also on this particular topic under Schedule 2 on going concern basis, on slum sale basis. If the transactions are happening, then there is no GST. We will discuss that later on. I will request WIRC to have a indirect tax refresher course also. And one more thing, it's nice to see you all here in this August gathering and discussing direct tax provision in detail. And this is the strength of our chartered accountants, that we go in detail and we serve our client to the best. And one more important thing for all of us is we have speakers like Yogesh sir, Nihar sir, who guide us, and it helps us immensely for a year, because now the new returns, tax audits and other provisions applications will start from July, August, September. This is a season of income tax, and these types of refresher course are of immense importance. So thanks to WIRC and thanks to all you for joining today. With this small brief note, I wish you all a happy learning. Thank you.
Thank you, Umesh sir, for your remark. Now I request Regional Council Member C.A. Gautam Lat kindly briefly introduce our today's speaker formally.
Thank you, Ankit. So friends, today we have with us Yogesh Thar. Yogesh is currently a partner with Bansi S. Mehta from Mumbai. He is a fellow chartered accountant and having a work experience of 38 years. He has to his credit authorship of several books and articles on direct tax and double taxation avoidance agreement published mainly by Taxman, CTC, BCAs. Mr. Thar has served as a member of committee of constituted by Honorable High Court in 2014 in relation to a major commodity market scheme in the country. He is a well-sought speaker on taxation. Thank you so much, sir. Let us welcome Yogesh Thar with a big round of applause, friends.
Yeah. Now before we present memento to speaker, let me take 1 minute to congratulate our Regional Council Chairman Arpit Bhai and Direct Tax Committee Chairman Ketan Bhai for superb show and for extraordinary successful of this event. Congratulate to both of you. Now I request Regional Council Chairman Arpit sir kindly present memento jointly with Ketan sir to our today's speaker.
Since Umesh bhai asked, why are we giving these paintings instead of mementos, so just let me take a quick 1 minute and tell you, these paintings are actual paintings, oil paintings by, specially privileged people. They have drawn these paintings by foot and mouth. All of these paintings are, and this year I have, as a part of the council, we decided that let us give this instead of the other stuff. This can be a good collectible also. You can proudly display it in your offices and walls. And, massive. When I visited their workshop, I could not hold my tears back by seeing them perform in this manner. And these are actual paintings. So a lot of this, of course, for them, and they also give charity. So they also ensure people around the country, if they find there are Divyangjan, as we said, they bring them, they train them. So it's for that good cause. So, sir, through you, we are making this charity also possible through Council, WRC. Thank you very much.
Now I request Yogesh sir kindly take the charge of session.
Dear friend Umesh, Ankit, Gautam, seniors in the profession, ladies and gentlemen, I'm aware I'm standing between you all and refreshments. But let's try and refresh ourselves with this topic, conversion of firms, companies, etc. Not a new topic as such, something which is going on for a few years now. But small issues keep on coming every time. So, opportunity to refresh ourselves of the provisions and try to be abreast of what are the recent controversies and what are the recent gray areas. Whatever I've tried to cover today are all gray areas, nothing which is absolutely white or absolutely black. And the idea of these conferences are really to, present before everyone what are the areas which are borderline cases where, more than one view is possible. And of course, try and share with you what I think is the correct legal position on the issues. The topic conversion of firms, companies, proprietary concerns and other forms of restructuring. I have concentrated mainly on conversion of firms, companies, proprietary concerns. The other forms of restructuring, I've just taken a couple of small case studies which are not the usual ones, some unusual ones, to just bring home certain controversial issues. So let's first deal with the conversion of partnerships into companies. Indeed, an old topic, but let's just have a refreshing look at the whole thing. There are two modes of changing over the business from partnership to a limited company. One is transfer of entire business undertaking from the firm to a company. And the other one is conversion of a firm into company under Chapter 21 of the Companies Act, which used to be Part 9 of the 1956 Act. So the first mode, where we are talking of a transfer, is essentially where there are two entities present. There is an existing firm and there is a company, and there is a transfer of the business from the firm to the company. So a two-entity, separate entity model is this first model that we are talking of. So here, normally we do this business transfer by way of a business transfer agreement between the two entities, and consideration passes from the company to the firm, or maybe from the company to the partners of the firm, whichever way you structure the transactions. And ordinarily, therefore, this is a taxable event because there is a transfer of business from one entity to the other. It's a taxable event. And question here arises whether this is a taxable event in the hands of the firm which is transferring the business to the company, or it is a taxable event in the hands of the partners, because partners who are partners in the firm, in place of their share of profit in the firm, what they are getting is the shares in the company, and therefore is it a taxable event for them, or is it a taxable event for both the firm as well as the partners of the company? So yes, it cannot be something which is taxable in the hands of both. If the firm is taxed, then what partners would ultimately get is the tax paid profits, and therefore the same cannot be taxed twice. And if the firm is not taxed and the partners are taxed, then that would happen only if you apply the principles of overriding title, that the consideration always belong to the partners, it never belong to the firm. So diversion by overriding title, they are taxed and therefore firm cannot be taxed. Ideally, both should not be and cannot be taxed. However, we are aware of certain cases where, not in the case of conversion of firms, but in case of demergers of companies, department has taken a view that double level taxation is possible. But they are aberrations to this whole thing. Now, so therefore, as I said, ordinarily this is a taxable event. And therefore, we have these provisions in 4713, which provides an exemption to certain types of transfers of business from a partnership firm to a company. And we are told that if all the conditions which are mentioned in 4713 are complied with, then this transaction will not be chargeable to tax. And negatively, we are told that if there is a non-compliance of any of the conditions in 4713, then there is a backup provision given in 47A3, where we are told that the capital gains which are not charged earlier will become chargeable to tax in the year in which the condition is broken. So this is the overview of that first mode which we are talking. We'll get into the details a little later. The second mode of this transferring the business from a firm to a company is the conversion of a firm into company under Part 9 of the Companies Act 56, or now Part 1 of Chapter 21 of the Companies Act 2013. So here we have Section 366 of the Companies Act, where we are told that partnership firms, LLPs, cooperative society, or other business entity which are formed under any other law can get registered under this act as a company. So what is happening is that there is an entity formed under some law. That entity is getting itself registered as a company under the Companies Act, and therefore the essential part of this is, essence of this is that it is the same entity which is only getting itself registered. It was earlier a firm or it was earlier a society. Now it gets registered itself as a company. So it's the same entity, and it being a same entity, there are no two entity theories, and therefore there is no transfer from one to the other. And if there is no transfer from the one to the other, there is no capital gains implications. So then we have these provisions which say that minimum 2 members should be there so as to register as a company. If there are less than 7 members, it can be private limited. More than 7 members, you can be private, you can be public limited company as well. Now, what is the effect of the registration? Effect of the registration under Section 368 of the Companies Act is that all property, movable or immovable, including actionable claims belonging to or vested in a company at the date of its registration, in persons of this part, shall on such registration pass to and vest in the company as incorporated under the Act. So it is a statutory vesting which happens, and if it's a statutory vesting, it is not a transfer. Now, if it's not a transfer, 45 cannot apply, capital gains cannot apply, because as we know, for capital gains to apply, there must be a capital asset, it must be transferred, and there must be a consideration which is passing. 3 essential conditions of capital gains arising. If there is no transfer, then there is no capital gain. If there is no capital gain, I don't need the exemption of 4713. And if I don't need the exemption of 4713, whether I breach the conditions, I don't breach the conditions, the disability provision in 47 capital A is not applicable. So this is the flow of the discussion that we are going to have on these mode 1 and mode 2. So now let's look at the first mode in a little bit of a greater detail. That is the business transfer mode, 2 entities approach. And we are told that there are certain conditions to be fulfilled so as to make this transaction tax neutral. And the first condition is that all the assets and liabilities of the firm relating to the business become the assets and liabilities of the company. That's the first condition. So what are the questions that arise in this case? So it says all assets and liabilities relating to the business. So question is, if a firm has some surplus asset which is not related to the business, some old land sitting somewhere, I'm not using it for the business at all, it's lying idle, what happens to that? Is it necessary that that asset should also be transferred, or can I say no, section only says that assets and liabilities relating to the business can be transferred? So answer is no. If it's a surplus land, then it is not an asset relating to the business, and section only requires that all assets relating to the business is transferred, and therefore those idle assets which are not used for the purpose of business, never used for the purpose of business, or discarded long time back from the use of the business are not transferred, then to my mind this particular condition will still be satisfied. It is not necessary that all the assets liabilities should be transferred. There is no requirement that the old firm has to dissolve. There is no such requirement, there is no such condition. So this is one possible way. However, one needs to take care that, you see, the section 4713 says that a transfer of an asset by a firm to a company as a result of succession of the firm by a company in the business carried on by the firm shall be exempt. So an essential ingredient of enjoying this exemption is that there must be succession in business. Now, what is succession in business has been extensively examined by the Supreme Court in this decision of K.H. Chambers, 55 ITR, long years back. And they have said, they have laid down certain principles. And if one sentence from there, it actually gives the entire gist of the whole decision. It says that the tests of change of ownership, integrity, identity, and continuity of the business have to be satisfied before it can be said that a person has succeeded. So the wholeness of the business should not be broken. The integrity of the business should not be broken. You cannot split the business into two. Then it doesn't remain successor in business or succession of business. So the integrity of the business remains the whole, the business as a whole, as it was carried on, is being transferred. Then it would be a succession. Now, if that condition is satisfied, it is still succession. Therefore, if there's an idle asset not related to the business, then I would feel that the integrity of business is not broken. It is still a succession of business. And if it is succession of business, you are satisfying the conditions of 4713 and you may be eligible to get this exemption. So this is something to be kept at the back of our mind, that in cases where, you want to corporatize the business and you don't want to corporatize one of your old properties, you want to keep the property close with the family, okay, then a possible way of doing it is this way, that, you transfer the business as a going concern to a separate company, corporatize that, enjoy that exemption, and that idle asset, certainly it should not be used for, that asset should not be, the onus will be very heavily on the SSE to prove that this is a asset not relating to the business. So what is relating to the business, what is not relating to the business has to be microscopically examined, before one jumps into a conclusion. But then this is something to be kept at the back of our mind, and in fit cases where, you have that old property which you really don't want to corporatize it, keep it with the family closely. This is one possible avenue that all of us may keep in mind. Then, the next one, the next condition is that all partners become the shareholders in the same proportion in which their capital account stood in the books of the firm on the date of succession. That's the second condition. And questions arise day in and day out on this interpretation of this. First question, would capital account include current account? Would capital account include partner's loan account? So far as current account is concerned, current account is really an extension of capital account. It is a creation of commercial requirement, between the partners, that to the extent of fixed capital, I don't pay interest, etc. A minimum capitalization. So it's a commercial requirement and accounting requirement. So current and fixed capital both are capital. And to my mind, there's no difference so far as, it's not a legal concept, it's an accounting or a commercial concept. So current account is capital. However, partner's loan account stands on a different footing. If you look at the provisions of section 48 of the Indian Partnership Act, that section actually provides for a waterfall mechanism in case of distribution of assets in the case of dissolution of firm. And there you find that there is a priority which is given to partners' advances as compared to the partner's capital account. And that is an indicator to show that partners' advances or loans are treated separately under the Partnership Act, and therefore partners' loans is different from a partner's capital balance, and therefore they need not be included. It can be treated as a liability as such, as a loan. So when we are saying that they should become shareholder in the same ratio, you need not include the partner's loan account. That is one. Second question, can some partners be issued equity shares and some preference shares? And can some partners be issued equity with more voting rights and some with less voting rights? Because the Question is, because the requirement is that they should become pro rata on a proportionate basis. So, I have a total capital of 100, 50 equity, 50 preference, and then therefore I say that everything is pro rata, proportionately given. Is it sufficient? It is right? Does it stand the test of complying with this condition or not? Is an issue. Now, prima facie, you say that, okay, look at section 43 of the Companies Act. What does it say? It says two kinds of share capital, equity and preference. Within equity, you have two further classifications with voting rights and with differential rights as to voting, dividend, etc. And therefore, capital, two kinds, and the section only talks about shareholders becoming shareholders. So equity shareholder is also a shareholder, preference shareholder is also a shareholder, and therefore, the partner should become a shareholder. Whether he becomes equity shareholder or preference shareholders, kya farak padta hai? That can be an immediate sort of a reaction. So at first blush, as I said, it appears that yes, it is doable, it is possible, one can take a view. However, there's certain catch. It talks of in the same proportion. Partners should become shareholders in the same proportion. Now, this in the same proportion, is it arithmetically to be calculated? Or in the same proportion, one has to look at the Companies Act and say, you are the shareholder in the same proportion, that means you have similar rights. A preference shareholder would have similar rights, equity shareholder would have similar rights, Class A shareholder would have similar rights, Class B shareholder would have similar rights. So how does one look at it? Arithmetically, though it does not make a difference, 50 preference, 50 equity, everybody is proportionate. But does it really stand to scrutiny of what do you mean by in the same proportion? Well, I would feel that the three reasons I would feel negative on this. One is that principles of interpretation in cases like this would take you to the common parlance test. What is common parlance test? Not the dictionary meaning. Dictionary meaning would give you arithmetic, proportion. But common parlance would mean how would a person in the industry look at it? So here is a requirement of holding the shares on a proportionate basis. So how would a person who is a shareholder look at it? He would look at it from the point of view of his rights under the Companies Act. And therefore, when you say that the shareholding should be in the same proportion, would really mean that it should be the same nature that one will see. So under the Companies Act, you would have different rights for an equity holder, different rights for a preference shareholder, and different rights for people having differential voting rights, and so on. So therefore, a mere arithmetic proportion would not be sufficient. One will have to look at the proportion from the point of view of the legality of the type of share. Secondly, the general principle which our courts have adopted time and again, one very popular decision is the decision of the Supreme Court in Sudarshan Chemicals in the context of ATHHC, where question was numerator and denominator, what it should have. There was export turnover to total turnover ratio. While deciding that, they said that if export turnover is there in the numerator, it should also be there in the denominator. Why? You cannot have without that. So you cannot compare oranges and lemon. That sort of a theory is there. And if one applies that theory, once again you come to this conclusion that equity, preference, you can't have a combination of the two and say that this is proportionate. So this is second reason which I feel that if one tries that, the court will someday intervene and say, no, this is not a correct position. Thirdly, as we'll go ahead, we will see amongst 4-5 conditions, this clause D also has a condition which actually talks about voting power. It says that the old partner's voting power in the new company should not be less than 50% for a period of 5 years. So that clause talks about voting power, this clause talks about shareholding, right? So the intention seems to be of voting power and therefore intention seems to be of equity shares. So therefore, I don't think that if you want to just give an exit to some partner without paying him something, and you just give him preference shares and then later on you redeem the preference shares and he's out, I don't think that that would really work in this particular scenario. So that is a second question. So literal interpretation versus, the looking at the entire scheme of the act to interpret a particular provision. The third question is, what if some partners' accounts are credited by revaluation of certain assets while it is a partnership firm? Issuing shares by the company based on the ratio so determined will qualify the test of in the same proportion. So I revalue certain assets and I give credit to partner A, not to B, give credit to C and not to D. And then I say, okay, this is the ratio and now I give the shares in that ratio. Is it possible to do it? We may keep on arguing. We used to keep on arguing for, on this issue. We never implemented this because we were always very scared of doing all these things. But now certainly you can't do it because you have the Supreme Court decision in this Mansukh Dyeing and Printing, which says the revaluation itself is a transfer. Right, wrong is a different thing, but today you have the Supreme Court issued a decision in the context of 45(4) of the old Act, the old 45(4), where they have said that revaluation and increasing the partner's account and partner taking away the money amounts to transfer. So therefore, I don't think we should be getting into that thing. So therefore, best thing is to align the capital balances before, converting, before transferring the business. You align the partner's capital such that the shares are issued to the partners. So alignment can be by way of introducing capital, withdrawing capital, or whatever it is. Then you have this clause C, and clause C says the partners do not receive any consideration other than allotment of shares. So there should be no other benefit received by the partners. The only benefit that they receive should be by way of consideration, by way of issuance of shares. So question is, if part amount is treated as a loan instead of capital, what happens? Because I want to repay it fast or whatever it is, or I want to pay interest on it. No, I think if you treat a part amount as a loan, then it is a benefit other than capital, and therefore you should not be doing that. Then if one shareholder director is given a monthly remuneration, so there are some working partners and some non-working partners, and you say that after it becomes a company, I'll give remuneration to those working partners, then what happens? That to my mind has no difficulty, because that's a contract which you enter into with those shareholders or directors after the conversion. It is not a consideration for the conversion, it is or for the transfer. It's a consideration, or rather it's a contract which is entered into after the conversion event has happened, and that should not have any difficulty. Would section 56(2)(10) apply in such allotments? Because there is an allotment of the shares by the company to the partners, and therefore would section 56(2)(10) apply? Arguably no, because the value of the shares received, by the partner in a company would be equal to the value of the business that he is transferring, value of the interest that he is transferring. And the fairness of this whole valuation is embedded in the law itself, which requires that the share allotment should be on a proportionate basis and no other consideration should be given. So therefore, the fairness of the whole thing is embedded into it, and therefore 56(2)(10) here would not have any applicability. However, this is subject to clause D, which we come to little later. So in this example, where all the partners are becoming the shareholders in the company and everyone is given on a proportionate basis the shareholding, there is no difficulty. However, there is this clause D which can create some difficulty, and that clause D says that aggregate shareholding of the partners is not less than 50% of the total voting power, and this should continue for 5 years. So it envisages a situation where the continuing partners who become the shareholders would be 50% or 51%, and there would be somebody else who is 49% or 50%. And in such an event, there could possibly be an enrichment of one at the cost of the other, and 56(2)(10) can come in types of such issues where one may have to comply with the 11UA requirement when the company is issuing shares to the shareholders or to the erstwhile partners who become the shareholders in the company. So this is now these are all the conditions. That takes us to certain other questions as to what is the cost of acquisition of shares. Now, so far as the direct provisions in the law are concerned, we have this section 49(1)(3)(e), which says that when there is a transfer from a firm to a company, and it complies with all the conditions of 4713, then the cost of acquisition of the asset. So a company tomorrow sells one asset which it has inherited, okay? And cost of acquisition of that asset, it says that you go to the cost to the previous owner, namely the firm. So it is in sync with the entire scheme of the act that when there is a transaction which is tax exempt, then you don't get a step-up cost, and therefore you look at the cost to the previous owner. So that provision is there. And similarly, backup provision is that for computing the period of holding of that asset, you also take into account the period of holding by the previous owner. So these provisions are there. However, when it comes to the partner who has now become a shareholder and those shares are sold, there is no backup provision at all here as to what would be the period of holding, what would be the cost of acquisition in his hands, and therefore the question arises as to how does one actually deal with this situation. We'll come to that when we do the proprietary concern thing, because similar provisions are there, and then I'll explain it by way of an example. So there'll be two approaches. One is you take a harmonious or a purposive interpretation that if a particular provision, if a particular transfer is exempt, and therefore in the fitness of the things, you look at the previous owner's cost, and you look at, so therefore I look at the cost that I have, cost of acquisition of the interest in the partnership firm. I look at that, and the period for which I was a partner over there also I should look at over there. That is one way of looking at it. And question is that will the indexation be available? Yes, indexation may also be available. We'll get into a little bit of detail for this example a little later. The other direct provisions are 72A6, which deals with the set off and carry forward of accumulated losses, and we are told that if 4713 conditions, these ABCD which we just saw, if these conditions are satisfied, then the successor company will be eligible to carry forward the losses, and not only the losses but also unabsorbed depreciation. The question here arises as to whether this carry forward by the company will be for the residual period, or will the company get a fresh lease of 8 years so far as losses are concerned. Now, this is a controversy which is there even for amalgamation of companies, even for demergers. This issue is there, and the provision says that it shall be deemed to be the loss and depreciation of the successor company for the year of succession. So if it is deemed to be the loss and depreciation of the year of succession, then it gets a fresh lease of life of 8 years going forward. So it's not just for the residual period, but it gets a fresh lease of life. That's the interpretation which comes in. And deeming provision will have to be taken to its logical end. That is the legal reason why I'm saying so. That takes us to mode 2, that is conversion under part 1 of chapter 21, which is equivalent to part 9 of the 1956 Act. And we have several decisions. The leading one is that of tax spin in Bombay High Court, where a view was taken that conversion of a firm into a company is not a transfer. Now, this tax spin decision stands on two legs. One is that there is no transfer, it is a mere statutory vesting, and therefore there is no capital gains. And then it goes on to say that even assuming that there is a transfer, there is no consideration. Because when a firm gets converted into company, what is the consideration accruing or arising as a result of that transfer to the transferor? So there's nothing. If the firm is a transferor and the company is a transferee, what is the consideration accruing or received by the firm? Nothing. So there is no capital gains computation possible. So for these two reasons, there is no capital gains. So while we have these 4 or 5 high courts, we also have a Supreme Court on this issue, but not exactly on this issue, but something which is related to Part 9 conversion. And a question arose in an ATIA deduction matter in that last mentioned case over here. that, ATIA infrastructure business, you're supposed to have an agreement with the government or a local authority. And in this particular case, that agreement was there with the government by that firm, which got converted into a company under Part 9. And the department said that, look, after conversion, that company does not have a separate agreement with the government, and therefore they denied ATIA. And Supreme Court went on to say that it cannot be denied, and it observed, which actually echoes the things, all the propositions that there is no transfer. Although this particular provision, this particular decision was not on transfer, but it echoes the same sentiment. It says it is manifest that all the properties, movable and immovable, including actionable claims belonging to or vested in a company at the date of its registration, would vest in the company as incorporate under the Act. In other words, the property acquired by the promoter can be claimed by the company after its incorporation without any need of conveyance on account of statutory vesting. On such statutory vesting, all the properties of the firm in law vests in the company, and the firm is succeeded by the company. The firm ceases to exist and assumes the status of a company after its registration as a company. So it observes this and ultimately holds that no, you cannot deny ATIA merely because the agreement was with that old firm. So fairly well settled position that there is no transfer which happens in the case of Part 9 conversion, and the language of Part 9 and Chapter 21, Part 1 of the Companies Act is more or less, it's almost the same. Now, at the beginning I also said that if there is a Part 9, you don't need 4713 conditions to be complied with. There is an argument that, look, in Taxpin's case, there is an observation that 4713 has been introduced later on. It was not there in the year which was there in the appeal. And therefore, the High Court did not comment on that. And therefore, a view is possible that, okay, Taxpin does not apply to post 4713 years. Okay, and therefore we say that even in conversion under Chapter 21, you need to necessarily comply with 4713 conditions. That is a possible interpretation which comes out. And that issue is addressed by the Bombay High Court in CIT versus Umicore, 76 Taxman, the first one decision over here, and also in a Bangalore bench decision, Unity Care, where they have gone on to say that in a conversion, there is no transfer, and because there is no transfer, there is no tax under 45, and therefore you don't need 4713 exemption, and therefore 47 capital A disability provisions will not kick in. So that comes out clearly from these two decisions, and I think correctly said so. Then, what is the holding period of shares in the hands of the shareholders? In this case. Now, let's understand this issue in a little bit of detail here. As I said, 4913E provides for transfer of an asset by the company. There you take the cost to the previous owner and the holding period of the previous owner. But no provision either for 4713 cases, and all the more for these cases there is no provision whatsoever. So, when a firm has converted into company under Chapter 21, the shareholder has started holding shares from today, and there's only, we are only told that those shareholders should remain shareholders for 5 years to the extent of 50% of their aggregate holding. So therefore, it is possible that some shareholder would like to transfer their shares also, and you will still not be non-compliant. So what will be the cost of acquisition period of holding of those shares? So 49, no provision. So therefore what? I look at the general provisions of 49. Do I do that? And general provision has two clauses. One is succession, one is devolution. Where they say that in case of succession, you see the previous owner. In case of devolution, you see the previous owner's cost. And therefore, does it take you to the cost of my earlier holding of the interest in the partnership firm? Does it take you there, or it doesn't take you there? Whether it is succession or not, as we observed earlier, Supreme Court in KH Chambers laid down the tests, and one of the tests was change of ownership. Now, if we take a view that in a Part 9 conversion, there is no change of ownership because the same entity continues. So there is no change of ownership. And if there is no change of ownership, it doesn't remain a succession. And if it doesn't remain a succession, then that 49 general clause of succession does not apply to you. So this is one possible view. However, interestingly, you have a Kerala High Court decision in 233 ITR where the question was of valuation of stock at market value. You see, when a business comes to an end, there's a requirement that the stock should be valued at market price. Now here there was a conversion from a firm to a company, and the question arose whether it should be valued at market price or not. So there Kerala High Court said, it observed that the lower authorities, the CIT appeals had decided the issue in favor, tribunal had decided the issue in favor on the basis that after considering KH Chambers, they still held that the firm was succeeded by a company, and the firm was succeeded by a company, it is a case of a going concern, and business as a whole is transferred, and therefore there is no dissolution, there is no requirement of valuing the stock at market price. So there is an observation of the Kerala High Court that there is a succession. This observation that this is a succession you also find in Taxpin's case, where they said in the present case we are concerned with a partnership firm being treated as a company under the statutory provisions of Part 9. In such cases the company succeeds the firm. So Kerala High Court and Bombay High Court uses the word succession or succeeds in a manner which I don't know whether it's really in a manner which is used by the Supreme Court in KH Chambers or not. So if these two decisions are the basis you take forward and say, okay, there is a succession and therefore 49 applies and therefore go to the cost to the previous owner under general principles, I'll go to my cost of acquiring my interest in the partnership firm. But I don't think we should rest our view only on this basis. You see what is devolution. Can you say that, okay, succession nahi hai, so it's a devolution? And there you get some help from Madras High Court decision in Krishnamurthy 152 ITR, which says devolution comprises not only disposition by a party's overt act, but also transfer of ownership by operation of law. The operation of law being dependent on the occurrence of a particular event or circumstance and not involving a full-fledged overt act or transfer. So do you say that this operation of law also includes the statutory vesting under the Companies Act, and therefore there is a devolution? Once again, doubtful to me, because this decision itself also talks about change of ownership, and in a Part 9 conversion there is no change of ownership. So slightly difficult. Third, principle of harmonious construction. That, you see, if a conversion is not a transfer, then the period of holding must be with effect from the year in which I became a partner, because there is no transfer taking place. And what I was earlier holding as an interest in a firm, I am now holding as a share capital in the company. So the nature of the asset has changed, but the asset remains the same, its nature has changed. A very fine distinction, and for this fine distinction also you find some support in the subsequent decisions I have mentioned over here. These are the decisions in agricultural, in the cases of agricultural land. You see, what had happened here was that a person was holding agricultural land he held for several years. That land was converted into NA. And as soon as it was converted into NA, he wanted to sell the land, and he earned gains. Now we know that it was agricultural land, it's not a capital asset if it's in the rural area, it's not a capital asset. Now it became a capital asset on one day, and thereafter soon he sells that capital asset. When he had acquired, it was not a capital asset. For several years, it was not a capital asset. Capital asset came into his hands by way of conversion from agricultural to non-agriculture, and soon thereafter he sells the land. Question was short-term or long-term? What is the cost of acquisition? And here the court said that you have to look at the price at which he had acquired the agricultural land. You have to take into account the holding period. Although it was not a capital asset, although all your section says that capital asset held by him for a period of 36 months, it may not be capital asset, but in this particular fact situation, you have to look at the period for which he held that land also as agricultural land. So if we take, this approach of the judiciary, if we take into account, then I would feel that one will have to look at the date on which I became the partner. I consider that date as the date of holding of my shares. And what is the cost? Then the question arises, what is the cost of acquisition? So the cost of acquisition was my initial capital that I put it in the partnership firm maybe 20 years back. Then every year there is plus minus in my capital account by way of new profits, by way of introduction, by way of withdrawal. And therefore that net addition can be cost of improvement. And at the end of the day, the balance standing to the credit of my capital account on the date of conversion is my capital, is my total cost, and I should get that total cost as a reduction. So cost of acquisition, the original capital, cost of improvement year on year, plus minus, that's happening, index it, bring it up to the date of conversion, that possibly is the cost of acquisition and index cost of improvement so far as this computation is concerned. This mechanism is something which we have sat down and debated and come to a conclusion. There is no other way in which one can really compute capital gains in a case like this. It's not something which is there in black and white in the law. Then in such cases, carry forward and set off of accumulated business loss. Now, if you take a view that there is no change in the entity, and if there is no change in the entity and therefore the losses should continue for the residual period of 8 years, it cannot get a new lease of life, unlike 4713 cases. It should continue for the residual period. That takes us to the other set of conversion of proprietary concern into companies. Now, chapter 21 option is not available over here because that chapter says that any business entity formed under some law can register itself into a company. Proprietary concern is not a business entity formed under any law, and therefore this chapter 21 option is not available. So therefore you have only 4714 mechanism by which you can claim exemption. Otherwise, there would be a transfer of business by a sole proprietor to a company, and which would be normally a taxing event. And if you therefore want it to be not taxable, you have to strictly comply with the 4714 conditions. And what are these conditions A, B, and C? A, all the assets and liabilities of the sole proprietary concern relating to the business become the assets and liabilities of the company. We have dealt with the issues earlier. The same issues would arise even in the proprietary concern cases. Shareholding of the sole proprietor is not less than 50% of the total voting power, and this should continue for a period of 5 years. So, again similar. Sole proprietor does not receive any consideration other than the allotment of shares. Similar condition in partnership. So, all the issues that we have discussed over there would all equally apply pari materia over here. What is the cost of acquisition of the shares? Cost to 4913E, as I said, cost to the previous owner applies only where the company sells. There is no provision where the shareholder sells the shares. Now, at this stage, I'd like to explain a little bit in a detail on the, as I said, two possible interpretations. One is what we saw harmonious interpretation when we dealt with the tax spins case and the Part 9 conversion. Now, here we are not in the Part 9 conversion, we are not in a statutory vesting position. We are in a position where there is a transfer and I am enjoying exemption because there is a specific exemption, I am complying with the conditions, and in those cases, what will be the cost of acquisition? In the case of sole proprietary concern, let us look at an example. So on the date on which, so I have a sole proprietary concern, I have my net assets of 100 and my capital of 100. The value of that 100 net assets is say 1,000. So my fair market value of my business is 1,000. If I were to sell this business, I would earn a profit of 900. There is an investor who wants to invest in my sole proprietary business, and he wants to come in a corporate form. So I have to transfer this business to a company, and if I transfer this business to a company, it's a taxing event unless and until I comply with all these conditions. So now I say that, okay, I'll comply with these conditions A, B, and C. The person who wants to invest in my business is not more than 50% because there's a requirement that at least for 5 years I should continue to be 50% partner. So he comes at say for example, he wants to come at 45%. So what do? I transfer the sole proprietary business, which is book value of 100. I transfer at 1,000 to a new company, which is today my own company, me and my family members. I transfer it to a company at 1,000. I comply with all the conditions of 4714 and therefore I enjoy the exemption. Now a new person wants to come in and he is going to buy the shares of 450 out of this because 45% of 1,000 will be 450 and he is willing to pay 450 for that. So therefore 45% of the shares that I got, I will transfer to that person and I will get 450 in my hands. The question is, that 450 which I get in my hands, is it taxable, not taxable? And how do I compute capital gains in this? If I take a view that, look, when I transferred the business of 100 at 1,000, what did I do? What you and I as accountant will pass an entry, I will say that shares in the new company account debit 1,000 because that's the consideration that I received. Okay? To credit net assets 100, credit profits of 900. I've earned that 900 profits. By virtue of 4713, that 900 profits is tax free. I'm not paying any tax on that. Now tomorrow, out of that 1,450 ka shares I'm selling, what is the cost of acquisition of that 450 shares? It's 450. There is no provision in the law to take you back to your capital in the sole proprietary business. There's no provision. So if I say that my cost of acquisition is 450, I am selling at 450, I pocket it, no tax. An aggressive view, certainly, and in today's day and age will be very, very difficult to sail through. It was very difficult to sail, it was impossible and we failed to sail through in the context of LLP that there is no transfer applying Bombay High Court in tax bin. So, cases like this, it will be difficult to sail through, but it's something which is certainly eminently arguable. Conservative view, of course, I have transferred the business as 1,000. I'm not going to pay the tax on full 1,000. I'll pay tax only on 450 because the whole purpose of this provision is to give me an exemption in case of genuine transfer of businesses or conversion from company, proprietary to company. So therefore, the worst case scenario could be I pay tax only on 450. I will not be paying tax on the whole of the 1,000. So that is the controversy over here. Period of holding, once again, the same issue. Indexation available. If I go by harmonious construction, the old period is counted. Otherwise, just new period. New period, I'm not worried because my cost will be the same as the selling price. Carry forward and set off of accumulated losses, 72A6 would equally apply the way it applies to the partnerships. Now that takes us to conversion of company into LLP. So here we have section 56 and 57 of the LLP Act, where a private limited company and an unlisted public company can be converted into LLP. We have section 58 which lays down what is the effect of the registration. It says on and from the date of registration, all property vested in the company, all assets, interests, rights, privileges, liabilities, obligations relating to the company shall be transferred to and shall vest in the LLP. So here, unlike the Companies Act Part 9, which uses the word pass on, shall and vest to, here they are saying transfer to and shall vest in. Be that as it may, it is still a statutory vesting. Despite the use of the word transfer, it is still a statutory vesting. However, because there is no two entities over here, there is no transferor and transferee, it is still a statutory vesting. However, we have these two decisions, Celerity, Bombay Tribunal, and Domino, it's an EIR. And I believe there is also one more tribunal which has followed Celerity to say that there is a transfer taking place. Of course, they said that the transfer had happened at book value and therefore there is no capital gains. But they have said that there is a transfer. Now, that being the position, 4713B compliance becomes mandatory, and if you do not comply with the conditions of 4713B, then you'll end up into this particular situation of taxability. And set off and carry forward of losses, you have a separate provision to deal with that. Now, what are the conditions which are mentioned in 4713B? So, all assets and liabilities of the company become the assets and liabilities. So, here the phrase relating to the business is not there. So, therefore, it anticipates the entire conversion of a company into LLP. The company does not survive, so there is nothing which remains in the residual company. So it's not just relating to the business; it's all the assets and liabilities. Then all shareholders becomes partner. Their capital contribution and their PSR both should be in the same ratio, same proportion as their shareholding. The question here arises as to the shareholders. Would they include equity shareholders as well as preference shareholders? The answer is yes. They would include equity shareholders and preference shareholders. And here we have the same question but the other way around. How do I work out the proportion? There's 100 rupee equity shareholder, there's 100 rupee preference shareholder. Do I make them two equal partners in the partnership firm? It's commercially unstatable, but arithmetically this is the way in which the proportion comes in. So here also once again, when you devise the partnership or the LLP deed, one may have to define the rights of the partners in the LLP, in sync with the rights as equity or as the preference shareholders. So for example, a partner's capital account could be pool A and pool B. Pool B may be preference and pool A may be, equity. And pool B preference dividend may be converted, into some fixed share of profit computed as a percentage of the pool B capital. So you may have to structure the partnership deed in a manner that it complies with the requirement of proportionate, that capital contribution and PSR should be both in a proportionate basis. Or if the amounts are not large, just redeem the preference shares, don't get into this controversy and then convert it. That's another way of going about it. So that is so far as this condition. Condition C is that the shareholders do not receive any consideration other than the share in the profit. Now, there is a Mumbai tribunal decision, recent one, where the LLP after conversion created a goodwill and credited that goodwill to the partner's capital account. And the department said that, look, that goodwill which was created is a benefit in addition to the shares that you have received, and therefore I will not grant you that exemption. You are not complying with the condition that the shareholders do not receive any consideration other than the share in profit. So the Mumbai tribunal said no. This is not a benefit upon conversion. This is something which is happening post conversion, and they also took note of the fact that there is a commercial rationale for creation of goodwill because there is some other partner who is going to come in, etc., and that is why you have created this goodwill. This is not something for hoodwinking the department and siphoning the monies off. So that is so far. Then that condition D is that the aggregate of profit sharing ratio of the shareholders in the LLP shall not be less than 50% at any time during the 5 years post conversion. Now, question is, what if the inter se PSR changes? I think there is no bar of inter se PSR getting changed. Then what if some old shareholders retire or die? The proportionate ratio is required only on the date of conversion. That same proportion theory applies only on the date of conversion. Thereafter, only the aggregate should not go below 50%. So long as at least one of the partners, one of that old shareholders continues to be a partner and he has more than 50% for a period of 5 years, there should not be any difficulty. What if the capital ratio changes? While the PSR remains the same, capital may fluctuate and the PSR remains the same. Now, this condition, that is the condition of aggregate of the PSR, this condition is only qua the PSR. This condition is not for the capital ratio. Capital ratio, PSR in sync is only upon conversion. Thereafter, this requirement of 5 years is only on PSR, it is not on the capital ratio. Sorry. Then clause E, total sales turnover or gross receipts in business of the company in any of the 3 preceding years is less than 60 lakhs of rupees. Now, what if there are receipts which are taxable under other heads, dividend, interest, income from house property, etc., which are more than 60 lakhs? So the language of section is receipts in the business of the company, and therefore if it does not constitute business, of course if it's a company which is an investment company, it may constitute a business. If it's a company whose business is to rent out properties, then house property income may be business. But barring those cases, income which are not business income, those type of receipts, I would feel that it would not get covered, and even if they are beyond 60 lakhs, should not be a problem. Then you have clause EA, which says the total value of the assets as appearing in the books of account of the company in any of the 3 preceding years is less than 5 crores. Now, what do you mean by the word value? Value means book value or fair market value. If it's book value, is it depreciated value or is it gross block? If it's depreciated value, is it book value or ITWDB? These are the issues. Now, when he says value of the assets is appearing in the books of account, how do I read it? Do I say that value of assets is appearing in the books of account? Or do I say value is appearing in the books of account? Sorry, one second. Sorry. So since they are talking of books of account, I would feel that they are not talking of a fixed asset register. They are talking of a books of account. So assets as appearing in books of account doesn't make sense. The value of the assets as appearing in the books of account makes sense. So I think it should be book value. And therefore, fair market value is out of question. Again, books of accounts means ITWDB is out of question. So the only question which really remains is whether gross block or net block. Safe view, I think, is gross block because depreciation is a provision which has been made, and therefore value as appearing in the books of account should be considered as gross block. Nonetheless, there is a possible argument to say net block should be considered. Why? Because depreciation is always obliterated from the cost of the assets that are gross block which is stated in the books of account. It is always obliterated, and if you apply the principles of the Supreme Court in Vijaya Bank's case, where they were dealing with provision for doubtful debts, they say that provision, if it's obliterated from debtors, it would really mean a write-off. So, and therefore they allowed that bad debts even though it was provision in accounts. So if I apply that theory, then probably the net block can be an answer. But as I said, safer view is that gross block should be considered. Assets, if the assets were revalued in the past, then what happens? Now, unlike your section 50B, which talks about, ignore the revaluation and all, here there is no such provision, and therefore, if it is revalued in the past, then I think one will have to include it, or you may, change that revaluation, bring it back to your original cost by way of a separate accounting entry before you do this particular transaction. Assets means what? Only fixed assets or all assets? Answer is assets. Assets would mean all assets, not just fixed assets. It would mean all assets, fixed, current, investments, whatever it is. And that too, you cannot set off the current liabilities from current assets to say net current assets only I'll take. Then clause F. No amount is paid to any partner out of the accumulated profits standing in the books of the company on the date of conversion for 3 years from the date of conversion. So post-conversion, can the partners withdraw balance in their capital account? There seems to be no bar in doing that. I cannot take away the past accumulated profits, but I can take away the balance in the capital account because so that takes us to the question as to whether if before the conversion I issue bonus shares, so that accumulated profits have become capital and then I can withdraw the capital. If that is the view, then what? Well, this section only talks about accumulated profits, unlike section 222, which specifically says accumulated profits whether capitalized or not. Here this section doesn't say whether capitalized or not, it only says accumulated profits, and therefore if it is capitalized, it ceases to be accumulated profits, and therefore I think it's possible to take a view that I can withdraw that portion after I convert myself. Then an interesting position of conversion of a firm into an NLP. How much time do we have? 5:30. Okay, fine. Conversion of a firm into an LLP. Now, a firm is established under the Partnership Act, and there is a separate schedule which talks about conversion of a company into LLP, a separate schedule which talks about conversion of a firm into LLP. So it is possible to convert a firm into an LLP. The specific exemption given in the Act is for conversion of company into LLP. There is no exemption of conversion of firm into LLP. And very, very interestingly, you find a board circular to say that as an LLP and a general partnership is being treated as equivalent except for recovery purposes in the Act, the conversion from a general partnership firm to an LLP will have no tax implications. So far, so good. Then it says, if the rights and obligations of the partners remain the same after conversion, that is also fine. And if there is no transfer of any assets or liabilities after conversion. Now, on the next day, I will transfer my stock in trade here. I should not transfer any assets and liabilities means what? So, very difficult to understand the import of this. First of all, I would feel that a firm transferring to an LLP or conversion into LLP, if I take a view that conversion is statutory vesting and there is no transfer, I am not worried. But if I say that celerity is a right decision and that AR ruling is a right ruling, that conversion is a transfer, then there is a problem. There is a problem even in the case of a firm. Now, merely because an LLP is treated as a firm for tax purposes, tomorrow they may change the law and say it will be treated as a company, then what do you do? So, conversion of a firm into LLP, the circular, to the extent it's a benevolent circular, we are happy. It will be binding on the tax department because it's a circular which binds the tax officers. Now, but then they're putting in conditions that if there is no transfer of any assets or liabilities after conversion, that seems to be difficult. Difficult to even grasp the meaning of that. But I would feel that by and large, what it wants to say is that it should be a case of a genuine transfer, genuine conversion, genuine corporate, genuine sort of change in the status, rather than doing something for the purpose of avoiding tax. So one may go by this circular in a fit case, and circular I think would be by and large binding, so should not be a problem. Then let's take up a couple of case studies. So here is a case study on a non-compliant conversion. A non-compliant conversion of a company into LLP. So we have ABC Private Limited. That ABC Private Limited would be converted into an ABC LLP. We are told that the turnover exceeds 60 lakhs and assets exceed 5 crores. So the conditions are not met. And if the conditions are not met, what happens? Now 4713B actually provides for exemption of both, exemption to the firm and exemption to the company and exemption to the partners or the shareholders. Company, they are saying not transfer, and so far as shareholders are concerned, their shares are getting extinguished and there will be no tax even for them. This is the exemption provided. Now, if it's a non-compliant conversion of a company to LLP, then what happens, assuming that these case laws, we have to live with it today, that there is a tax exposure. Now, so we have to see in the hands of the company, we have to see in the hands of the LLP, and we have to see it in the hands of the shareholders. The Bombay Tribunal in celerity said that there is a transfer, but it is at book value and therefore there is no tax. Is that an absolute correct reasoning? It's, to my mind, somewhat doubtful. That not because it's at book value, but because there is no consideration accruing or arising as a result of this transfer in the hands of the company which gets converted. Because company does not receive anything, company dies its death and it gets converted into an LLP. And therefore there is no consideration accruing or arising. Not because there is no book value, but because the company, there is no consideration accruing or arising to the company, there cannot be any capital gains in the hands of the company. Applying tax spin itself, where as I said earlier, it stands on two legs, no transfer and no consideration. Now, an argument against this possibly could be that, look, under the Contract Act, a consideration can pass to a third party. You have agreed that you pay consideration to my shareholders by way of interest in the partnership firm, interest in the LLP. So your consideration has been passed to a third party and therefore what's the problem? There is a consideration. So answer to that is this. Yes, there is a consideration. It's not nil consideration. There is a consideration, but no consideration accruing or arising to the firm. To the company, which gets converted into LLP. And therefore, in the hands of the company, which is ultimately succeeded by the LLP, there cannot be any tax liability. The tax liability, therefore, arises in the hands of the shareholders. They were the shareholders, their shares get extinguished. Once their shares get extinguished, there is a transfer. You have grace collis to say that in the case of amalgamation, there is an extinguishment and therefore there is a transfer. In consideration of that extinguishment of shares, what are they getting? They are getting interest in an LLP. And therefore, what is the capital gain in the hands of the shareholder? The value of the interest in LLP, what they receive, minus the cost of acquisition of their shares, becomes the capital gains in the hands of the shareholder. Now, 5 minutes, all right. So that is the value in the hands of the shareholder. The capital gain in the hands of the shareholder is this. The value of the interest in the LLP minus the original cost of his shares duly indexed, whatever it is. The question arises, how do I value the interest in the LLP? Supreme Court in Sunil Siddharth says that the share in profit in the future is something which is in the womb of the future. It can't be valued, consideration can't be determined, and therefore capital gain fails. Fine, that is Sunil Siddharth. Today you have section 50D. And 50D says that if you cannot determine, then you look at the value of the asset that you have given up. Now what is the asset that you have given up? The shares in the company. Look at the fair market value of the shares of the company. Question is, how do I value the shares of that company? Number of ways in which you can do it. The question is, will 11UA value sail through? Or I should get into DCF and the fair valuation, internationally accepted methods of valuation. I would feel that the Income Tax Act, although 11UA is for the specific provision of 50CA or 56(2), etc., it is for the purpose of capital gain calculation in 50CA. Why should it not be for capital gain calculation over here also? Because ultimately 50CA will also apply because there is a transfer of unlisted shares. And that being the position, if you apply 11UA valuation and compute the capital gains in the hands of the shareholder accordingly, to that extent, the shareholder's liability sets. Therefore, if there is no significant immovable property in a particular transaction, then you may not land up in paying a very high tax. Of course, reserves and all will have to be taken into account. So that is the implications. And in the hands of the LLP, question arises that LLP, is it receiving without any consideration? No, it is not receiving anything without consideration because it pays. The partners are given the interest in the LLP, and in any case it is not receiving any property as understood under 56(2) because what it is receiving is an undertaking, and receipt of an undertaking, the asset undertaking does not fall within the definition of property in 56(2)(10), and therefore there is that provision does not get attracted so far as the LLP is concerned. So that was non-compliant, this thing. Just a couple of minutes on this and before I close down, I wanted to bring this issue on table, merger of Section 8 companies. And what happens is that in an amalgamation, you have the amalgamation definition which says that, one of the condition is that, condition 3, that shareholders should become shareholders of not less than 3/4 in value in the amalgamating company should become the shareholders of the amalgamated company. That's a necessary condition for the definition of amalgamation. And if this condition is not satisfied, then it is not amalgamation within the meaning of the act, and therefore all your exemptions you don't enjoy. Now in a Section 8 company, Section 25 company, charitable companies, which are guarantee companies, which are limited by guarantee, not limited by shares, you can't issue shares. And therefore this third condition can't be satisfied. And if it can't be satisfied, what will you say? Will you say that amalgamation, it is not amalgamation within the meaning of the act, and therefore I will levy capital gains on the entire value of the undertaking which is getting, or entire value of the assets which are getting transferred. Can I do that? To my mind, answer is no. Amalgamation exemption will still apply. It will apply without compliance of condition 3. And condition 3 is a condition which is not capable of being complied with. And if a particular provision of law is not capable of being complied with in a particular situation, that cannot be implemented. For that, you have certain authorities. You have a decision of the Bombay High Court in London Hotel's old decision, which was in the context of bad debts. You know, where bad debts provision was already debited in the past. Now, when the bad debts actually occurred, I could not debit the profit and loss account. So department said that you're not debited the profit and loss account. How do I allow your deduction? It's not possible to debit the profit and loss account twice, and therefore this condition is not capable of being satisfied today, and therefore you cannot deny me. So that was there. And then in the context of 44C, head office expenses, there are decisions that if, those head office expenses, there are 44C, there are conditions. If one of the conditions is not capable of being satisfied, you will still, that disallowance will not apply to you. So, so for the proposition that if there is a condition in the law which is not capable of being satisfied in a particular case, then that condition will not apply to you. If you satisfy other conditions, you should still be eligible for exemption. But this is, as I said, gray area in the sense that it needs some sort of a clarity. And finally, last 1 minute, demerger issues, where interesting issues have come up because of a definition of the resulting company in the Act. You see, you have ABC Private Limited, in that it has its shareholders. Now, this ABC Private Limited demerges one of its division to a wholly owned subsidiary of XYZ Private Limited. Okay, so ordinarily, it is the transferee company, namely that subsidiary of XYZ, that company should issue shares to the shareholders of ABC. Now, here you have a situation where the subsidiary is not issuing shares to the shareholders of ABC, the holding company is issuing its shares to the shareholders of ABC. And the question arises as to whether this is permissible or not, because in 219AA, one of the conditions of demerger is that the resulting company should issue its shares to the shareholders of the demerged company. Resulting company here is a subsidiary of XYZ. Demerged company is ABC. So subsidiary, that is the WOS, should issue shares to the shareholders. However, interestingly, the term resulting company has been defined to mean one or more companies, including a wholly owned subsidiary thereof, to which the undertaking of the demerged company is transferred in a demerger, and the resulting company, in consideration of such transfer of undertaking, issues shares to the shareholders of the demerged company. So the resulting company is wide enough to include the holding and the subsidiary both, and therefore if the holding company issues shares to the shareholders of that demerged entity, it should be a compliant demerger. So that's the interpretation which comes out from Because otherwise, what meaning do you give to these words in the parenthesis, including a wholly owned subsidiary thereof? So because of these wordings, this possible interpretation is there. Well, friends, if there are any questions, I'll be happy to take them if time permits. Otherwise, thank you very much for a patient hearing.
Friends, please hold on for 2 minutes. Let me make one or two announcements. Number one, since there was a meditation program in this auditorium on the first floor and the outside space was also occupied, we couldn't, organize simultaneously the high tea. We'll be organizing it in another 5 minutes within this hall. So please bear with us for today. For next weekend, that is on 16th and all those things, we have ensured that not to happen. Coming to the present task of vote of thanks, I think Gautam and Ankit were actually, conceptualizing some program and they were under the discussion. And since it is about to end, let me do this task of VOT. Also, the next session is on the 16th and the timings are 5 to 8. So kindly note that in your diary. It's Friday 16th and 5 to 8 and that day the speakers are Jagdish Punjabi. The topic is taxation of JDA, Joint Development Agreement, and charitable trust amendment will be taken by Vipin sir, Vipin Batavia. With this, coming to the present task of vote of thanks, if I go back in my memories in 90s, during my articleship, I used to do the audit of one of the largest conglomerate of India. And I know a lot of restructuring used to happen in that group. And, always when we were discussing and we were talking in audit, कि ये restructuring हो रहा है, वो restructuring हो रहा है. And I used to listen one name from them was Yogesh Bhai's name. कि, we'll go to Yogesh Bhai, take his permission, take his tax advice. And that's there in my memory, and I know he has been, advisor to many such restructuring, leading restructuring of India, be it, valuation, be it taxation aspect. And we are very, very, honored and thankful to Yogesh Bhai for sparing his valuable time. In fact, he had a lot of commitments. And we requested to reschedule his talk to today so that we don't miss on his talk. Sir, really thankful to you and looking forward for some such more session at the WIRC, at the Western India Regional Council for the benefit of members. I'm sure everybody would have seen kind of clarity, the thought process, the so much complicated provisions he made so simple. And with his kind permission and the permission of Nihar Bhai, we'll host this the entire PPT on the website of WIRC. So don't worry, you will get the material with the permission of the speakers. Let me put on record sincere thanks to Yogesh Bhai and requesting all of you to carry it with the loud round of applause. Just give us 2 minutes. We are organizing the high tea. Please have high tea. It's a request. Please have high tea and then you can go and even CP slips you will able to post. Just give us 2 minutes and comfortably have high tea and then you can have even networking during IT for half an hour, 45 minutes. Don't rush to go. काम तो चलते ही रहेगा, but these kind of networking will happen over if you all are here. I'll request. Yeah, we have kept pineapple syrup for you, and I'll request chairman to come on the dais for a photograph with Yogesh Bhai, Ankit Bhai. Please join.
चालू करेगा. Hello. One of the members have just reached out to us saying it's a Friday and it is 5 to 8. So I think वो चौवियार के चक्कर में So people who are having this Choviar thing, please can come at 4:30. So 4:30 to 5, we'll keep some snacks for you so that, you know, people who are having Choviar and all can really do that, and we can sit for a long session 5 to 8 and have a great, because trust taxation will be there. So I'm sure there will be a lot of deliberations. So request all of you, you can come by 4:30. You can have snacks here together. Thank you.